depth and breadth has surprised economists and guests across the board. And it's a much more resilient economy.
The consumer hangover eventually will come, but we're not seeing any signs of it yet.
When you look at the health of the market, I think you still have to argue it's pretty broad.
The ability for equities to go considerably higher as earnings become clear is what we have to focus on.
For the equity markets, the important thing is this soft landing is continuing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market is bouncing back by 0.4% on the S&P 500. We begin this morning by talking about a single name in the pre-market, Lyft. Now picture this. You've spent hours, days going over your earnings report and then you release it. And you say margins are going to increase 500 basis points. The stock surges 67%. You get on the call and go, oops, I meant 50, Bramo, not 500.
So here's the question. First of all, is this just Lyft being a rather peculiar company that has a reputation of doing things in its own bespoke ways? Or is this something that's more nefarious? A lot of people saying a clerical error is not necessarily securities fraud. Can you imagine if you were on the other side of this, though?
If you were short?
Exactly. Given
brutal.
That. Yes.
Brutal. The stock is still up by 17%. The numbers were actually quite good. If you go through the analyst reports, they're talking more about the results themselves than they are the shocker of saying 500 when you meant 50.
That's the difficulty here. They actually did really well. They included projected earnings as much as 11% higher than expectations. This is good to report. Why would they have to muddy it up with something that is so distracting and really just stealing the headlines with unnecessary sort of dismay?
And no idea what the counterfactual is. I know it's a pointless exercise, but it's worth a couple of seconds. Where would the stock be this morning without that taking place yesterday afternoon, yesterday evening?
Up 21%.
Is that the call?
I don't know. It would be higher. I think that you're right. It would be higher because although, you got to wonder what management is doing if they allow this to go through. And so it raises some extra questions that they just didn't need.
350 basis points higher than where we are right now. Just to be clear, just to get that clear. No extra zeros here whatsoever. Let's turn to the broader market. Bond yields yesterday higher, much higher. The 2-year this morning, 460. Lisa, we need to talk about inflation. Inflation yesterday, a hot CPI report, might not be enough to derail the story the Fed is telling, but it certainly chips away at the story this market was priced for.
I love some of the commentary. I think Julian Emanuel at Evercore ISI won, saying Goldilocks in the first gut punch, basically talking about how everyone was talking about soft landing. The narrative starts to shift to that hot landing type of scenario or no landing that Stuart Kaiser was talking about. And you see the market and you see all these analysts pushing back their expectations for rate cuts and talking about how the broadening out of inflation is exactly the wrong thing that the Fed wants to see. So now they want to hear Fed officials push back and say it's seasonal, it's one-off, which they don't think that
That's
they will.
the side of the Fed, but this also had political ramifications because you have all these basic categories going up. Food, dining out, energy bills when it comes to electricity. What struck me is that the gem in this report was something that was dogging the administration a few summers ago, and that was the fact that gasoline prices are lower. Can you imagine, though, if gasoline prices were to start to take in some of that risk or something bigger happened in terms of the conflict in the Middle East?
Expectations were pretty elevated coming into the year that maybe all of this would fade away and fade quickly. The Bank of America Fund Manager Survey, which we talked about yesterday, just listen to this. The most optimistic global growth in 2 years, magnificent sentiment, they're calling it. Only 7% expected higher pricing pressure. Very, very one-sided, Lisa, going into that report.
Which is a reason why we saw the biggest move, particularly in small caps yesterday, almost 4% decline, which was the biggest going back to June 2022. A real knee-jerk reaction that a lot of people were saying were driven by quants and the shorts and the people who are coming out who all were one-sided to this soft landing narrative. Here is the rub. Do we see this shift with people coming in and buying who've been talking about how there's an opportunity, but these are just rich stocks? Or do you start to see a more significant narrative shift about the broadening out of inflation pressures, which is exactly the opposite of what the Fed has to see and what the Fed has to do to really counter that?
We've got a bounce this morning. The Russell is up by about 1%. Broader equity futures on the S&P 500 positive here by about 1/3 of 1%. Yields yesterday a whole lot higher this morning, just a little bit lower, down 2 basis points. On the 10-year, 428. 87. Coming up this hour, Russ Kostrick of BlackRock following yesterday's sell-off, John Lieber of Eurasia Group with a standoff in the House over aid to Israel and Ukraine, and Sarah Wolf of Morgan Stanley on the state of the economy and retail sales coming later this week. We begin with our top story. Coming off the back of a sell-off in both stocks and bonds, traders pushing back Fed rate cut bets following a hot CPI report. Russ Kostrick of BlackRock holding on to June, saying this: the CPI print illustrates while inflation is decelerating, it will not be a straight path. We continue to believe that June is the most likely month for the Fed to begin cutting. We expect 3 rather than 4 to 5 cuts this year. Russ, I'm pleased to say, joined us now. So, Russ, let's talk about the data. Let's build on yesterday, this morning. Is that enough to derail the Goldilocks soft landing hopes and dreams of 2024?
Well, good morning, Jonathan. I don't think so. The number was a bit hot. Just, to remind everybody, we were expecting 0.3 on core. We got 0.39. Clearly the wrong direction, but there is some estimation error around this. And I think the broader issue is inflation is heading lower, but there are parts of it on the service side that are sticky. We saw that again on owner equivalent rent. And while it is going to go down, it's not sliding as fast as the market had expected or as quickly as you needed to validate that narrative from late 2023 when the Fed was going to start cutting in March and they were going to cut 7 or 8 times. We still think the Fed will begin cutting late this spring or in the summer. We still think 3, maybe 4 cuts are likely. But again, it's just not going to be a straight line. There are going to be months where you get a little bit of a backup. So I don't think the narrative changes. But again, taking some air out of that sort of high expectation we had back in late 2023.
Russ, let's take stock, though, of where the economic mix is at the moment. Output data, the economy a little bit hotter than we thought it would be. Maybe shelter inflation a little bit stickier as well. When you look at that as a mix for the time being, is that bad for both stocks and bonds or better for one versus the other?
Well, I think it's better for stocks, is the short answer. I mean, obviously, yesterday was a tough number for the bond market. It reacted as you'd expect it to. Stocks took their cue from bonds. But, the flip side of this is we have an economy that, let's say we get 2.5% inflation in 2024, and we get another 2% growth, which might even be on the low side. If you've got 4.5% nominal GDP, there's a decent shot that earnings estimates are probably a bit too low, and we're actually going to beat that. So I think that despite yesterday's action in the stock market, it's probably going to be a decent year for U.S. equities. We can probably put another 6, 7, 8% of what we've already done year to date, and there's reason to stay long equities.
Well, this really raises a question of which equities, in particular, because some of the more cyclically exposed stocks, and I'm thinking particularly small caps, have gotten more and more beaten up the more people push back their expectations for rate cuts. When does that stop?
Well, I think it's why small caps are getting beat up. Last year you had this beta-driven rally in November and December after a tough late summer and fall, and small caps benefited. I think the problem for small caps right now, it's an odd point in the cycle to get long small caps. The quality is much lower than the large and the mega caps. And as we saw again yesterday, they are rate sensitive. So if we have an environment where rates are not falling as quickly as the market believed, small caps, early growth, these parts of the market are sensitive. So I think the short answer to your question is what we're doing, we're barbelling the portfolio. We're still long many of the mega cap tech names that are high in quality. We think benefit from long-term secular themes. And we're also long higher quality cyclicals. There's still a lot of parts of the market in airlines, in autos, and parts of the consumer sector and healthcare that are actually pretty cheap, despite the premium that the market trades at. Large parts of the market were left behind last year, and there is some value there.
How underweight bonds are you? Because you do see that as sort of the underperforming sector in a scenario that you just put out there.
Yes, we are still a little bit underweight bonds. In our main fund, call it maybe half a year relative to our benchmark. So we have been cautious. We do think that spread assets still look good. You can carry in the portfolio well, something we probably have not been able to say for 15 years. But the long end of the curve in particular, we've remained cautious. Part of it is, the over-optimism about when the Fed's going to cut and how much. And the other part of that is supply. We're still in an environment where you've got a significant amount of supply with some of the actors backing away in terms of who's buying that. So still a bit underweight bonds, again, with most of that underweight concentrated on the long end of the Treasury curve.
It begs the question, Russ, when do you start getting interested? 450, 475, you waiting for 5% again?
I think it's a good question. I don't think, 450. I mean, again, it's always dependent upon the context. And obviously, if you're printing hot on inflation, that number goes up. But, as a rough estimate, I think if you got to 450, it starts to get a bit more interesting because we do think inflation is heading down. We do think you're going to see core inflation probably in the 2 to 2.5% range by the end of the year. So if the market gives you an opportunity and you're seeing 450, then I do think it becomes a bit more interesting relative to where we were a couple months ago.
Russ, what do you do on a day like today, or a day like yesterday, I should say? Are you the kind of person that says, okay, a sell-off, this is a dip, it's viable? Or are you the kind of person that says, you know what, we have our allocations, just stay steady and see how things go?
Look, I think the market did give you some opportunities yesterday. I mean, particularly in the morning, the late afternoon, that's a pretty dramatic sell-off. There were parts of the market that, you may want to go back and take a look at. But I do think that the narrative did not change yesterday. It reminded us that the path down in inflation is going to be bumpy. It's not a straight line, but we still believe the economy is in good shape and inflation's heading lower. So I think the short answer is you mostly stick to your plan. Let's talk about your plan with regards to equities and finish on that overweight in equities that you were talking to Lisa about. Is the US still the only game in town? I don't think it's the only game in town. We actually also have an overweight in Japanese equities, which have been interesting for the first time in, take your pick, years, decades. But I do think the U.S. is the best game in town, and there are a couple of reasons for that. The U.S. is still the most resilient economy. We're seeing that every day with the economic data generally coming in strong. But beyond that, we still like this theme of quality. We like consistency. We like profitability. And we look throughout the world and we look for companies that have those characteristics. We still find more of them in the United States in tech, in healthcare, and consumer discretionary than anywhere else in the world. Hey, Russ, good to catch up. Russ Kostrick there of BlackRock. Underweight bonds, overweight equities. Just a final word on Japan. The move in dollar-yen yesterday, that was a 1 percentage point move in yesterday's session against the Japanese yen. Well, the response from the authorities. I'm aware. Some of the recent rapid moves are in line with fundamentals, but some are clearly speculative. I think the latter aren't desirable. That is the Vice Finance Minister for International Affairs for Japan. And the response from markets, show us the action. What's she going to do about it? Yeah, exactly. What's she going to do about it? They're going to hike anytime soon? I mean, they can talk a lot, but people don't think there's going to be any action one way or another until at least 152 per dollar. Still north of 150.59 on dollar yen this morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny. Hey, John. Defense Secretary Lloyd Austin has been released from hospital after undergoing a procedure for a bladder problem. The Pentagon says he will work from home until later this week. He had canceled a trip to Brussels to meet with other defense chiefs and will now join virtually this morning. Austin was hospitalized in January following complications from prostate cancer treatment. It sparked furor after he waited days to inform the president and Congress. UniCredit poised to increase its overall bonus pool for last year by about 16%. The Italian lender posted record profit and increased shareholder returns. The average gain per person will be higher because of job cuts in 2023. The increases will be between 9 and 27%, according to sources. It does buck the trend of other European investment banks who are planning to reduce pools after a challenging year for securities units. Democratic Tom Suozzi has won the race to succeed ousted New York Representative George Santos. Suozzi defeated Republican challenger Mazi Pilip, taking 54% of the vote, with 93% of votes counted. The victory flips the seat back to Democrats and narrows the GOP's razor-thin majority in the House to just 6 seats. And that's your Bloomberg Brief. John. Hey, Danny, thank you. Appreciate the update. MH, let's talk about this just briefly. Was that really a referendum on the sitting president?
Well, the fact of the matter is, this is a district where immigration became one of the top issues that people were going out to vote from. And I come from just outside this district, and I can tell you it's a long, far cry from the southern border. So when you think about looking at November, if immigration is weighing on Long Island voters, it's going to be a big issue for President Biden. But what Tom Suozzi did was he took it to Biden saying there was moments in Congress when I served that I went against my party and saying that he thinks the border should be shut down. So he didn't try to shy away from it, but potentially it's a way you're going to see some Democrats in hard districts actually maybe put some blame on Biden for the border. Interesting. John Lieber of Eurasia Group, by the way, about 5 minutes away. Up next on this programme, aid for Israel and Ukraine forcing a standoff in the House.
I urge Speaker Johnson to bring it to the floor immediately. Immediately. There's no question if the Senate bill was put on the floor in the House of Representatives, it would pass.
That conversation coming up next, live from New York City this morning. Good morning. This is Bloomberg. Bouncing back just a touch on the S&P 500, down yesterday by almost 1.4% at the close. Just erasing some of those losses towards the end of the day. This morning, futures are positive by a third of 1%. Yields are lower by 2 or 3 basis points, 428.68. Under surveillance this morning, aid for Israel and Ukraine, forcing a standoff in the House.
I urge Speaker Johnson to bring it to the floor immediately. Immediately. There's no question that the Senate bill was put on the floor in the House of Representatives, it would pass. It would pass. So I call on the Speaker to let the full House speak its mind and not allow a minority of most extreme voices in the House to block this bill even from being voted on. This is a critical act for the House to move.
Here's the latest this morning. The White House urging Speaker Mike Johnson to bring a $96 billion foreign aid package to the floor. The bill facing a tough audience in the Republican-led House, where border security remains the priority. Johnson writing, quote, House Republicans were crystal clear from the very beginning. Any so-called national security supplemental legislation must recognize that national security begins at our own border. John Lieber of Eurasia Group joins us now for more. John, we've been talking about this now for weeks. The House can pass one bill, the Senate can pass another. Are they going to pass the same bill anytime soon?
Eventually, they're going to have to, but that bill may not include anything they've already been working on. They've got to do this government shutdown bill on March 8th. And if they don't, they're going to have a much bigger problem a political problem on their hand than either the tax bill or the Ukraine aid bill that they've already passed. That March 8th deadline is a really key one that we're watching to see what can get done here. I would anticipate the House is going to attempt to add their tax bill to the appropriations bill that has to get done. But the Ukraine aid, the House clearly has no intention of doing anything on and seems to be operating on a very different timeline, which means we could be in the middle of March still talking about this issue.
Well, could the foreign aid also be attached to those spending appropriation bills?
It could, but there's a bit of a chicken and egg problem because the House has to go first on the appropriations bills, most likely, and it's extremely unlikely that they're going to be the ones who attach the Ukraine aid, which means the bill would go over to the Senate, where the Senate could potentially, we know they have the votes, attach it to the appropriations bill, send it back over to the House. But then you're in a situation where Democrats and Ukraine supporters are risking a government shutdown by trying to jam the House at the last minute. And so far, they haven't been willing to do that. They could have done that in December, and they decided not to.
Yesterday, Hakeem Jeffries says there's more than 300 bipartisan votes for this foreign aid package. I know it's very early in the morning to try to even think this could happen, but could we see a discharge position on the House of Representatives floor?
I think the discharge petition is an extremely high degree of difficulty to get done. I mean, you've got timing issues. There's only really 2 days a month when you can vote on this thing. You've got to make sure you've got unanimous Democratic support, which you may not get if there's aid to Israel that's attached to the bill. And you've got to find enough Republicans who are willing to buck Speaker Johnson, who right now looks very weak, in order to get this done. This is a very, very narrow path. And it's really unclear to me that they even have the ability to do so. So right now, that's not my expectation. I think that the appropriations bill is a much more likely path. And if that doesn't work out, then, Johnson yesterday was talking about the House working its will, which is normally code for putting something on the floor and then trying to amend it. We're not really sure what he's thinking yet, though.
John, I got to say, yesterday I was wondering why Senate Republicans would put themselves on the line if they knew it was dead in the water going to the House and would go against certain members of their base. Do you have an explanation?
I think the tact is, live to fight another day. And that's all they're trying to do, muscle this thing through the Senate, demonstrate that there's bipartisan support. To Leader McConnell's credit, the vote did grow. And you had 22 Republicans in support of the measure in the Senate, which is a signal that enough Republicans do support it to pass it in the House. But now the ball is in Johnson's court, and that's really out of the Senate's control.
We're all trying to look forward to see when we can get out of this political dysfunction that feels like it has reached a new level. Tom Suozzi of Long Island did win that election, taking over for Republican George Santos. He is a Democrat. This is what he was saying in his victory speech. The people of Queens and Long Island are sick and tired of political bickering. They want us to come together and solve problems. Is that representative of a way that people can win, or is this representative of Long Island that just ditched George Santos?
Yeah, look, it's very typical for a member of Congress to say that voters want problem solvers. There's even a problem solver caucus in both the House and the Senate, but it doesn't actually do anything to break through the political gridlock that the U.S. faces. I mean, you're nominating a very extreme candidate on the Republican side and a very old candidate on the Democratic side, neither of whom seem really well positioned to reach across the aisle and solve problems right now. So I think it's really telling when you look at the State of the Union and you've got, Democrats who bash President Trump and yet hurry down to the floor to take a picture next to him. The appearance of bipartisanship seems to be more important than actually coming together and solving problems and agreeing on policy solutions in Washington.
John, can we talk about President Biden just a little bit as well? There were reports that Biden called the Israeli leader an a-hole on 3 separate occasions. And then there was another report in Axios yesterday summarising a meeting that took place maybe 12 months ago about how angry the president was with his team over the border. This feels strategic. I don't know whether it is or isn't, but it feels like it is. Is angry Biden part of the campaign now for the next 9 months?
Yeah, I think if Biden doesn't look like he's angry about what's going on in the country, he's going to look like he's out of touch, because you got a lot of voters that are really angry with, continued high prices, the situation on the border, and kind of the chaos globally. So I completely agree. These are strategic leaks. The Biden administration is moving to shore up its left flank everywhere it can. It's one of the reasons they started to put conditions on aid to Israel before the vote in the Senate, because they want to make sure that people know they get the message that their stance on Israel has not been popular with their base. And they know that immigration is the biggest vulnerability for them in their reelection. So they got to start doing more on this topic throughout the rest of the campaign.
Immigration is. I was actually struck by how much it played in a role with the ad spending and how much they were talking about it in a district on Long Island. So if immigration is Biden's number one concern right now, and he's trying to shore up independence going into November, what can he do in terms of executive action to look like he is at least acting tough on the border?
He's a little limited here because he's got the same problem he has in Israel, where he could do something, but he's going to start to lose the left flank because they think that a lot of the actions that, for example, President Trump took were inhumane. So, things like Title 42, which allowed Trump to expel asylum seekers back to Mexico immediately, these things are just not really on the table for him. Republicans did hand Biden a bit of a gift. We talked about this last week when they denied the border bill that Biden was willing to sign, because now he can say, I tried to get something done. The Republicans refused. But you're going to see him start to probably put more resources down there and instruct DHS to do more to export people and give clearer messages to migrants coming over the southern border that they aren't welcome. But he is a little bit limited in the terms of the tools, not because he doesn't have the actual processes, but by the politics of it.
Hey, John, thank you. John Lieber there of Eurasia Group. Appreciate your time. AMH, I wonder what you thought of that write-up from Axios yesterday about a meeting that's taken place in the last 12 months that, just so everyone knows, the president was furious with his team and then didn't change any personnel whatsoever.
Furious with his team, furious with the fact that there seems to be that no one within the administration, according to this Axios report, wants to actually own the border. So it does seem to be like some people are coming in and out of trying to solve this problem. But to your point, we do see the campaign lean on Doc Brandon a lot, with those laser beam eyes. And I never thought of this idea of angry Biden, but
angry Biden seems to be strategic. Don't you see the same thing?
How do you express your dislike of something without changing policy? How do you end up trying to seem fired up and ready to go?
Without changing personnel? Without
changing personnel. You try to shift your stance to some level, right? I mean, this raises this question of where some of the communications people are. I mean, really, the Instagram post with I like chip cookies.
I know. Did you see John Stewart, what he did with that? Brutal.
But even worse, it wasn't Instagram. It was TikTok.
All right, thank you.
Which is under CFIUS review. And you have members of his own party in Congress saying, I'm not going to tell the president how to campaign, but that does unnerve me.
We're not going to do a Super Bowl interview, but we'll do a TikTok video about how much he likes cookies. I mean, I just can't.
I mean, Jon Stewart.
I can't with that.
Cookies. That was great.
People are upset with Jon Stewart. I hope that Jon Stewart actually makes fun of both sides throughout the whole campaign. I hope this is what he does all year.
I think that he's pretty committed to it, as he said. It's not just the day of the election, it's the day after.
Equity futures right now on the S&P. Up next, what a difference an extra zero makes. It's Lyft, just around the corner. Bouncing back from the biggest one-day loss on the S&P 500 in about 2 weeks. Equity futures right now positive by 0.4%. The hot inflation print enough to upset the latest fairy tale on Wall Street. The bears have returned and Goldilocks was still there. Do you like that, Bramo?
Oh, that was good. I like Goldilocks and the first gut punch. I'm going to keep going back to that.
I like that too from Julian Emmanuel.
Oh, so good.
Well. That's great.
It's just basically, the reality check to the fairy tale you all think you're living in.
Sort of derailed things just a little bit for a moment. Let's turn to the bond market. 2-year, 10-year, 30-year. We had a double-digit move across the curve. About 2-year out to 10-year. This morning, lower by a couple of basis points, 429.66. On the 2-year, Lisa, we're back in the 460s. On a 2-year, when there was all this talk of dropping sustainably below 4%.
It wasn't just sort of lip service or a market move. You also see a lot of strategists coming out and reducing some of the rate cut expectations. The bottom line is, this was bad on every level. The super core metrics that the Fed loves rose the most going back almost 2 years. I mean, this is not what they want to be seeing at a time where they're hoping for a broadening out of disinflation, not a broadening out of inflation.
We'll talk to Sarah Wolf of Morgan Stanley in a moment. I think we need to compare and contrast CPI with PCE and the weightings on shouts for one and not the other, and how derailed this might be for the Federal Reserve. You and I said right after the number came out that maybe this changes things more for the market than it does for Fed officials, given the guidance they've given us over the last few weeks.
They can stick to what they've been saying. And frankly, nothing really changes. They've been talking about 3 rate cuts. The market was talking something like 5 or 6. Now people are talking, I was looking at Carl Riccadonna over at BNP, for example. He changed his recommendation, or he changed his expectation for this year, pushing it back and having fewer rate cuts simply because of this broadening out in inflation pressures. Yes, PCE will be more important, but the bottom line is, this doesn't make them confident.
Let's turn to foreign exchange. Dollar a whole lot stronger off the back of that bond move. The euro sub 107, 106.98. This from the ECB this morning. Roses are red, violets are blue. We're nearing our target and we will reach 2. Did you see that? This is what they tweeted. I love this from Michael Brown. I'm not going to use his language. I'll adjust some of his language. Roses are red, violets are blue. We messed up the last cycle and we will this cycle too. Well, that's the comeback to the ECB this morning.
All I can say is happy Valentine's Day to everybody for these wonderful poems. I am curious how they plan to message this, given the fact that they're seeing more weakness. We also heard from Luis de Guindos, the vice president of the ECB, coming out and saying that we're not ready to start cutting rates and blah, blah, blah. And people are like, whatever, good luck with that.
Well, Fed officials, ECB officials, BOJ officials too have all got something to say. Dollar yen, 150.64. There's just a feeling, Lisa, and there's always just a feeling in markets sometimes. Sometimes there's something to it, other times there isn't. 150 feels like this line in the sand for BOJ officials to come out and say, yeah, enough, you've had your fun, we don't like it here.
But is it the line in the sand for them to actually say, OK, now we're going to do something about it?
Yeah, that's different.
Because it seems like, they're going to come out and say it and everyone's like, all right, yep, we've heard this before. And then they keep on selling. But here's the question. When do they actually pull the trigger on something more meaningful? And when do they actually have to raise rates or stop some of the bond buying or do some of the incredible financial repression that has taken that country?
Words need to be credible. They need to be credible. And if you're going to keep on saying it, at some point you need to do something. That rate hike conversation has got to grow in the weeks and months to come.
Otherwise, you're going to see more of the same. And that's, I think, what you're seeing right now in the market.
150.63 on dollar yen. Under surveillance this morning, Fed speak on deck after yesterday's inflation data. Chicago Fed President Austin Goolsbee, Vice Chair for Supervision Michael Barr, both speaking today with more data due out later this week. Investors looking to retail sales tomorrow, PPI and consumer sentiment on Friday. FOMC meeting minutes come out a week from today. Retail sales, the one in focus for me, Lisa. If retail sales holds up, if that's looking really hot, then you go back to that Stuart Kaiser conversation over at Citi. You start to tip the scales back towards overheating and away from soft landing.
Russ Kostridge said that this doesn't shift the narrative.
Not for him.
Not for him. I wonder how many people are starting to say, maybe it doesn't, but I'm starting to look elsewhere. When you take a look at Coca-Cola raising prices by 9%, when you take a look at elsewhere and some of these price pressures that people are absorbing, you have to wonder, why people are accepting that and continuing to buy. It's because they have money. And that's where retail spending comes into play. And frankly, this question of just whether it was a sudden repricing in January or whether it's something more lasting.
To be fair to Russ, though, already underweight bonds and
sure.
overweight stocks.
So you got it right, so it doesn't change the narrative.
That's why it feels good. Let's turn to the politics. Democrats picking up a seat in the House. Voters in Queens and Long Island choosing Democrat Tom Suozzi to fill the spot left vacant by ousted Republican George Santos. Suozzi beating Republican opponent Mazi Pilip 53.9% of 46.1%, and 93% of the votes have been counted so far. The race seen by some nationally as a referendum on President Biden and immigration policy. The GOP currently holding a 219 to 212 majority in the House. AMH, that margin gets slimmer.
A lot slimmer. And if you look at the vote that was taking place just before the polls closed in New York, it was the impeachment of Secretary Mayorkas, and they won by the slimmest majority. They won by one vote. And remember, it was deja vu because they already tried to impeach Mayorkas and they didn't have enough votes. Steve Scalise, who's undergoing blood treatment for cancer, came back to take that vote. So this is what you're going to start to see when you try to get through some of these very partisan bills. Everyone's got to be there and show up. The majority they have is so slim.
What was the strategy in this race that you think could possibly carry over to the national race?
So I think there's two things. We can't forget that Tom Suozzi is a known name in this district, and Mazi Pilip was brand new to the scene. And after George Santos, potentially some said, let's go back to what we knew. Santos was a little bit of a chaos in that district, to say the least. But when it comes to the national stage, instead of backing away from immigration and the fact that what we see in our polling is that most voters lay the blame at President Biden for this, he took it on, saying, I think we need to shut the border. I think more needs to be done. And there was instances when I served in Congress representing this district, I actually bucked the trend of my party.
I imagine we'll see a lot more of that in the months to come, going into the general a little bit later this year. Let's finish on this story. Lyft gaining in the pre-market, but pulling back from a run-up of as much as 67% after reporting an error in its outlook yesterday. The ride-sharing company initially saying margins would expand by 500 basis points before correcting the figure on the call to 50. A company spokesperson said the mistake was a, quote, clerical error. Still, bookings and earnings coming in ahead of expectations as Lyft looks to compete with Uber. Bloomberg's Alex Webb listened to the call, looked at the numbers and scratched his head as well. Alex, let's talk about it. How on earth does that happen?
We hear a lot about fat fingers when it comes to trades. It kind of looks as though this might be a fat finger on a physical keyboard. It's kind of mind-blowing that such a thing would happen. You know, if you ever speak to finance departments, the detail, the laboriousness with which they go through their earnings statements to make sure that it gets legaled and there's nothing awry, and yet somehow it seems this mistake, which looks like a case of human error, it somehow snuck through. There was a line from one of the lawyers, or from a lawyer in the story, who says that this doesn't look like it's markets fraud. It just looks like it's a human mistake, but it clearly doesn't make Lyft look very good.
Alex, have you given thought to the potential legal consequences of this?
Well, I mean, I am no lawyer. I wouldn't be surprised if there are some people who perhaps do raise some sort of legal channel, take them to court on the basis of this, because they might have made or lost money in that short window where they hadn't yet stated the correct numbers. But it's hard to know how that stands up in court, given it's just an accident, it seems like, right? And so I wouldn't be surprised if something comes up. It's hard to predict how that plays out.
It's one thing to have a fat finger on a Twitter post. It's another thing when it is the release is your financial results for the company. Typically, those are proofread. Typically, there's more than one person to look over this. What does that say about how this company is managed? Does this sort of raise questions for investors and analysts about what's going on there?
So that's the risk, but not in isolation, right? So if you have a few instances of a seeming lack of attention to detail, a few flubs here and there in the way that, frankly, the company is run, it doesn't really seem like that is happening, at least not yet. There is a relatively new leadership team at Lyft. I think the thing that's one reason why the reaction was so outsized initially is this is a big year for Lyft. It could be the first year in which they post a profit at least on an operating basis, if not quite on a net basis. So the fact that it looked as though they might massively outperform expectations was huge. They have, as we know, colossal competition with Uber. Uber has different revenue streams. It has international revenue streams as well. It is very much the 500-pound gorilla in the room, whereas Lyft is a little bit more, well, you could say it's more agile, but it struggles to compete financially with Uber. So that's why an attention to detail is super important, because it's working on way finer margins than Uber does. At the moment, we don't have evidence that there is more than this kind of error, but it puts management under a lot of pressure to ensure that such mistakes don't occur.
Alex, I have to say, just even the idea of a clerical error makes me think of someone in the back room with little cue cards trying to file them. It sort of harkens back to another era. Just moving on, though, there is this point that the earnings were strong, that they really did show growth in earnings, and people are using ride-sharing services at a pretty significant clip. Is this a broader statement on consumer appetite, consumer ability to keep spending? Because it's not just Lyft, it's also Uber. It's not a market share thing. This is just an all-in spending thing.
Yeah, and it was interesting that they attributed some of the gains to big touring events, Beyonce, Taylor Swift. The fact that people are going out to live entertainment, there was some questioning whether that boom that we saw immediately after the COVID pandemic was starting to taper a little bit. But according to the statements from Lyft yesterday, it doesn't really look like that's happening. They're really getting that tailwind of people going out and trying to enjoy life, which is good news across the board for when you think about any industry that's dependent upon consumer sentiment. So, yes, they are clearly benefiting from that. At the same time, the fact that a few big live touring events can affect their earnings to the extent that they're willing to talk about it shows actually that maybe they are dependent on a few small wins in either direction in order to keep on the trajectory they want to.
Alex, thank you, sir. Alex Webb there of Bloomberg, just slowly moving past the so-called clerical error and looking at the move this morning off the back of fairly decent earnings. We're higher by 21% in the pre-market.
Evidently, Taylor Swift is to blame or to thank. Yeah, she evidently runs the world, and she's the reason why ride-sharing services are, seeing the ridership.
Every single conversation. I didn't realise that Uber was up by close to 100% over the last year.
The earnings have been incredible, and this really isn't, we were talking about during the pandemic, how long are people going to spend $30 to get their $12 salad, right? I mean, there's sort of this question of how much people can actually spend on this stuff, and it turns out they can keep spending. I mean, this to me highlights the abilities of consumers to spend. Maybe it's that they want to spend because Taylor Swift and Beyonce, but I think that there are other things too. They just speak to an incredible amount of cash that just hasn't run out.
Do you want to talk about that salad that rhymes with sweet and green? Do you want to talk about that? You notice that it's got maybe less in it than it used to have.
Are you saying
that?
shrinkflation?
I'm just saying that maybe shrinkflation
green?
Might be a thing about a salad place that rhymes with sweet and green.
Yeah, especially if you get the protein and it's like cut in half.
You ask for chicken and it's just like,
it's one strip.
Couple of strands of something,
Yes.
they sort of get the carcass and they spray off what meat's on it. That's what it feels like when you go to some of those places that just sort of throw some protein.
Talk about, I'm sorry.
I know it's early. If you're enjoying your breakfast, I'm sorry. But that's what, sort of some of those salads feels like.
Shredded. I hear you. I mean, this has been going on for a while. And it's, at what point are people willing to pay to get more chicken?
Maybe the president is onto something, Gramo. Maybe he's onto something.
Of course he is. We've been talking about shrinkflation for a long time. But
maybe
this
longer.
has been forever. Exactly. I mean, you get, instead of 8 ounces, you get 6 ounces.
Yeah,
I mean, how long
and
have we got
pay the same, if not more.
Of course. But this is, maybe some people say this is sort of the treatment.
It's greed. It's what happens when a company goes public, It's not. Maybe it is. Equities right now on the S&P 500 positive here by 1/3%. Let's get an update on stories elsewhere this morning. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. House Republicans voted by the narrowest possible margin to impeach Homeland Security Secretary Alejandro Mayorkas. An attempt last week to impeach the secretary failed after a deadlock. One lawmaker returned from cancer treatment to reverse the embarrassing defeat. Mayorkas becomes the second cabinet member in U.S. history to be impeached. The effort is likely to die in the Senate, where a 2/3 majority is needed to remove him from office. Shares in Airbnb are lower in the early trade. The company reported strong fourth quarter results on continued post-pandemic travel demand. But Airbnb expects the number of nights and experiences booked to moderate this quarter as demand normalizes. Jeff Bezos has sold another $2 billion of Amazon shares after he sold $2 billion last week. Regulatory filings show the sale of 24 million shares took place just over 4 trading days. The world's second richest man has said he plans to dispose as many as 50 million shares in the company he founded. Amazon is up 11% so far this year. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Appreciate it. It's either incredible market timing or the most phenomenal midlife crisis in human history. Just absolutely amazing. Can you imagine having that kind of access to that much money?
So there is a theory.
What's the theory?
It's taxes.
Yeah, of course. Capital gains tax
Over in Florida?
Washington State.
Yeah, that basically he left Washington State in November and goes to Florida. And I think he saved something like,
the
let's see.
7% tax on $250,000 or more in capital gains in Washington State. You get none of that in the Sunshine State of Florida.
And that means that he probably saved $288 million so far because of that move in taxes that he didn't have to pay.
That's awesome. Isn't that incredible? The amount of money you can save by making that move.
Are you planning on moving to Florida?
I don't have that much cash, Bramo, to make that kind of trade.
You're gonna cash out of your surveillance shares?
If I did, without a doubt, I'd buy the boat, I'd go sailing, I'd do the whole thing.
The lemon groves?
Yeah, absolutely.
Yeah,
the Amalfi Coast, all of it, just everything.
We'll work on that.
We'll try. Up next on this program, US inflation running hot.
The strength of this economy has befuddled economists. I think the Fed's made the right choice. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left in that gun.
That conversation coming up next, live from New York City. This is Bloomberg. Equities on the S&P 500 positive here, a third of 1%. We're down about 2 basis points on the 10-year, 429, down just a little more than 2 basis points on the session. Under surveillance this morning, US inflation running hot.
The strength of this economy has befuddled economists and all your guests for the decade. And if you look at where all the dot plots have been, even those folks who have all the information have missed this. You are seeing some signs of a hardening of economic conditions that are finally coming up. I think the Fed's made the right choice. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left.
Here's the latest this morning. Traders pushing back Fed rate cut bets from June to July after yesterday's hot CPI print. Sarah Wolf and the team at Morgan Stanley forecasting a rising core PCE after the latest data, writing this: we think the sequential prints in the first quarter will be overall higher than what we've seen in the last 6 months. This acceleration will be one factor delaying the decision to start cutting rates to June of this year. Sarah Wolf joins us now to get into some of that data. Sarah, can we just compare and contrast what goes into CPI and what goes into PCE, and just how wide is that spread right now, just in terms of where those two numbers are?
PCE is everything that you spend and then everything that gets paid on behalf of you. So think about health insurance, for example. Your employer pays for that on behalf of you, so that'd be captured in PCE and not CPI. There's also different weighting. So PCE, the weighting evolves each month when consumers shift their spending preferences. And so typically CPI and PCE run very closely, but right now we're seeing a pretty large wedge between the two measures. And right now CPI has been running quite a bit above PCE. Our implications for PCE right now, based on CPI, it's actually for 0.3 core PCE this month compared to a 0.4 on core CPI. So it's looking a little bit better. And one of the key things is that core services looks like it's going to be a little bit softer in the PCE print than the very hot core services that we saw in CPI.
You know, normally you would expect some kind of commentary from Fed officials. This is just one print. Ian Lingen over at BMO Capital Markets said typically one would look to the Fed to deliver assurances that a single data point doesn't make a trend, but we're skeptical of that approach given current conditions. He talked about how trying to explain away the strength in CPI is going to be tough because of the broad-based nature of price increases. Do you agree with that, Sarah?
It definitely was a very broad-based increase this past month. If you look at the breadth of acceleration in the CPI print, it was fairly wide. If you look, for example, you could look at the Cleveland Fed trimmed mean measure, and that showed a pretty notable acceleration. So it's definitely worth watching, but we do have to remember it is one data print. We saw 3+ months of soft CPI and PCE prints. It gave us a lot of confidence that inflation was on the right trajectory. This is exactly why the Fed said that they wanted to see a few more pieces of inflation to believe that inflation was sustainably moving towards 2%. And it's exactly for this reason, because you could get some outliers like this where CPI reaccelerates. Right now, I believe that they're going to say it is one data print, but they're going to keep watching. So it doesn't change the Fed's trajectory. But if anything, it does keep June firmly on the table, where it's just enough time to get a few more prints and feel confident that this is just a one-off. It's not a break in the data. We do get 3 more CPI prints ahead of the next Fed meeting, then a 4th on the day of the next Fed meeting in June. And then we also get 4 more job reports, actually. So there's quite a bit more data to come before you get to that June FOMC meeting this summer.
Sarah, you sound a lot more sanguine than a lot of the analysts that I was reading reports from, who are all saying this actually is significant and this is kind of a game changer when it comes to just the broadening out. You can't just explain this by seasonals. Do you agree? Do you think that there's like a messiness underneath some of this data that makes it dismissible as sort of a blip?
There's definitely some issues with the seasonal factors. The government agencies are trying to get it right, but we know there's a lot of noise there and maybe a bit of a bad signal that could be coming from some of the seasonal factors. But we also know that some of these components are on the right trajectory. Shelter, for example, that reaccelerated in the latest print, but all of the forward-looking indicators on, the new tenants index, for example, is showing to a much cooler path for shelter inflation in the back half of the year. So even though we got this jump right now, I think we could feel confident that the forward-looking data is still looking fairly solid for shelter, which is about 1/3 of the overall basket. Then you look at the other core services, and that's very tied to wages in the labor market. I think that's where we're a little bit more concerned. We've been seeing progress in wages for about a year now, but now with this reacceleration in payrolls, it definitely calls into question, can we feel confident that core services ex housing is going to remain on the right trajectory? And I think that's yet to be seen. It's hard to know if this reacceleration in payrolls the last few months is here to stay, or if it's a little bit of a one-off and we're going to see some reversion in the February and March data. So it bears watching, but it's too early to pull it out as this is where the future of inflation.
Richmond Fed President Thomas Barkin recently talked about some of these companies that had to raise some of their prices. He says is it conceivable now that's off the table? Will they continue to do this? When you look at some of these basic food prices, for instance, going up, will they have to maintain these elevated prices to maintain a profit?
It's going to be tricky for them because we know that consumers are also becoming a bit more price sensitive, in particular at the lower middle income distribution. And so even though, labor costs are high, so it forces them to push some of that pricing through, we know that it's becoming increasingly difficult because of a household that is pulling back a little bit on their spending. We know lending standards are tightening, access to credit is getting more difficult. And so there's less of that willingness to take price among households, and that's going to be pushing back against households, against businesses and their ability to pass through price.
Sarah, let's finish by talking about the weather and retail sales. Can we do that just briefly? When payrolls came out, just before it, people told me that it was warm, so payrolls are going to be good. And now I'm being told it was cold and retail sales won't be great. How is there a difference between the two? Is it a survey week? What was it?
It looks like there is a bit of a survey week problem. The first half of January, that's mostly captured in the payroll report, was a bit warmer. The back half was a bit colder. Retail sales will capture the entire month. So it'll capture the warm weeks and then the cold weeks. What we're actually looking for in retail sales is a negative 0.5% on the month. Part of it is weather, but most of it is seasonal factors. And not to get a little nerdy here, but historically the seasonal factors look for massive holiday spending in November and December, and then a big drop off in January. The seasonal factors have been a little messed up for retail sales the last few months because of abnormal holiday spending patterns. And we think that it's not going to be adding enough back into retail sales in January, given how strong November and December sales were and the big decline we're expecting for January. And so be looking for that, the unfriendly seasonal factors for Thursday, retail sales, and it's going to result in a negative print. We think that could take some of that pricing also back from July into June, showing a little bit more deceleration in consumer spending, and also showing that maybe some of that strength that we saw in November, December retail sales was actually the bad seasonal factors working in the other direction as well.
Interesting. Appreciate the clarity. Sarah, thank you. It's good to see you. Sarah Wolf there of Morgan Stanley. Going into retail sales tomorrow, Lisa, they're looking for a negative number. The street is as well. The survey here at Bloomberg, the median estimate, negative 0.2%.
Yeah, if you strip out some of the seasonalities, though, the control group is expected to have 0.2% of an increase. Honestly, if you get a hotter than expected print for retail sales, what does that do to market action?
Yeah, that starts to get you talking about overheating even more, right?
That, I think, would really build on maybe not a narrative shift, but maybe just a little gut punch.
Just sort of leaning
Yeah, just sort
further to the other direction.
Yeah.
You love this Goldilocks taking a punch thing. You know,
I do
remember when I told you about kids tuning in accidentally, turning off the cartoons and tuning into business news?
And they're getting very
Abramowicz
disappointed.
talking about fairy tale characters getting smacked around.
It's the new, I don't know, it's the
by
new
economic
cartoons.
data.
Yeah, no, it's pretty wild. It's pretty exciting.
Coming up in the next hour, more excitement. Tracy McMillan of Wells Fargo, Michael Shepard of Bloomberg News, Pierre Ferragu of New Street Research, and Colin Martin of Charles Schwab. From New York City, equity futures on the S&P 500 positive by 0.4%. Live from New York, this is Bloomberg.
The depth and breadth has surprised economists and guests across the board, and it's a much more resilient economy.
The consumer hangover eventually will come, but we're not seeing any signs of it yet.
When you look at the health of the market, I think you still have to argue it's pretty broad.
The ability for equities to go considerably higher as earnings become clear is what we have to focus on.
For the equity markets, the important thing is this soft landing is continuing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market is bouncing back on the S&P 500 by 0.5%. Plenty of laughs and jokes about Lyft's move overnight. Just a ridiculous move off the back of numbers that weren't real. 500 basis point guidance for margin expansion this year turns out to be just 50. That stock fades, still positive by almost 20%. And good news for Uber shareholders. Lisa, this one just dropped in moments ago, announcing a $7 billion share buyback.
Which really builds on all of the buybacks and dividends that we've been hearing from a lot of companies. I have to say, it feels like there's a new emphasis on that with near record pace of some of these being announced. They talk about an inaugural $7 billion share repurchase authorization. And this comes as Instacart laid off a whole host of people and authorized share buybacks and dividends. So there seems to be a new focus on distributing capital in an era where people want income from those shares, because guess what? They're getting a lot of money, and the owners want to get some piece of that.
And they've got the money to do it. We're talking about buybacks at Uber, first one. We're talking about a dividend at Meta, first one. These are big changes.
Especially at a time where there's a new emphasis on exactly how profitable someone is and what the growth potential is. And guess what? These companies are meeting it. And that, to me, is a shocking thing at a time we were supposed to be talking about decelerating growth.
Well, we're going to talk about hot inflation right now. The takeaway on the south side. Lisa's gone through some notes already this morning. Citi, service inflation is sticky. Bank of America calling it a detour from disinflation. It is nightmare on Biden Street. AMH, that print yesterday.
Yeah, it is. What you're going to see from the White House is they're going to say, remember where we were and look how much far we've come. But Treasury Secretary Janet Yellen said she was loath to talk about any one variability in one inflation report. But the issue is, when you look at what's going up, it's issues that you cannot escape. Every day, Americans are reminded that grocery prices, whether you're dining home or eating out, are going up. The only gem in this print report was that gasoline prices decrease so much. And there's also obviously potential going into the summer that could pick up.
Is it too soon to talk about Max Kentner and HSBC and reverse Goldilocks? Payrolls report comes out. It's just one print, just one payrolls report. Wage growth looks hot. ISM manufacturing gets closer to expansion. It's just one story, just one economic data point. Services comes out. Bit hotter than expected. Prices paid picked up. Yeah, early days, January. Don't put too much weight on it. CPI drops. It's just a drip feed of hotter than expected data.
If you get the same from retail sales, how much does that sort of play into this? And then the question is, Stuart, this is right for you. Is good news bad news? And I looked and said, at what point does it really become a headwind? And it's not there yet. And I think that was sort of the consensus from a lot of different analysts. Stuart Kaiser of Citigroup saying our base case remains positive on strong economic data and a dovish leading Fed. Do we, though, get a situation where bonds get blown out and stocks do well? Is that kind of the dichotomy that we're seeing at a time where inflation is a bit stickier than
Russ Kostrick, BlackRock, what did he say 60 minutes ago? We said, look at the economic mix right now. Does it favour one asset class over the other? He said stocks versus bonds. Underweight bonds, overweight equities. That's his trade at the moment.
We're hearing that from a lot of people, because why would you want to own the bond? I mean, we heard that yesterday from David Kelly. You're not going to get the capital appreciation. You're going to get the coupon. If you want the coupon, go fish. If you don't, maybe go to equities.
Got a bounce in equities this morning. Equity futures on the S&P 500 positive here by 0.5%. In the bond market, yield shaping up as follows. Lower at the front end by 5 basis points, back to about 460 on a 10-year, down 2 or 3, back to about 428.68. Coming up this hour, Tracy McMillan of Wells Fargo on why it's time to get defensive in stocks and bonds. Bloomberg's Michael Shepard on the Republicans' shrinking majority in the House. And Pierre Ferragu of New Street on Nvidia's relentless rise to the top. Pierre Ferragu also covering Uber and other big tech names as well, Bramo. So a lot to get into with him a little bit later.
Yeah, I want to hear about the dividend and the buybacks and whether this is a new play, that basically cash distribution is a new acquisition in tech world.
We begin with our top story. Markets shaken by sticky inflation. Futures and treasuries signaling a smaller rebound following yesterday's slump. Tracy McMillan of the Wells Fargo Investment Institute saying the Fed is likely to put off its first rate cut until at least June, and recommending investors lighten up on the top 12-month performers, including tech, consumer discretionary, and by energy, industrials, and healthcare. Tracy joins us right now. Tracy, I just want to recap some of your calls coming into this year. You said March and a rate cut in March was too early. Looks like you're correct. You said market pricing for 150 basis points of rate cuts was too aggressive. So far, so good. Tracy, you said services expansion will fall into contraction. Now, based on what we've heard so far this year, that's one looks a little shaky. Is that still your view?
Yes, it is. We think that we will start to see some weakness in consumers, really on the margins. And we're basing this on a couple of things. First of all, we're starting to see delinquencies that are concerning in credit cards and auto loans. Mortgage delinquencies have also started to rise, and student loans are probably next. We're also seeing a labor market that is not quite as tight as it has been, January's print aside. It looks to us like it is starting to weaken on the margins with hourly or average hourly work weeks declining, and also with temporary workers also starting to decline. So that's where companies can start to cut employment on the margins. And so, we think that those two factors are probably going to play into a little weakness in the consumer and a bit of a slowdown as we move into the next couple of quarters.
What would you have to see to change your view on that?
Yeah, so in order to change our view, we'd want to see a continuation of strong labor markets, and we'd also want to see some reversal in those delinquency numbers. Like I said, autos, credit cards getting up to a level where we think that is starting to be concerning. Retail sales tomorrow, you mentioned that earlier. We would want to see those continue to come in relatively strong, although, like you said, that could be a problem for inflation. So either way, we think that the Fed is probably going to be on hold here at least until June. And so that is causing this repricing that we're seeing in equity markets.
Tracy, we've heard from a whole host of different investors that they prefer stocks over bonds in a time where inflation is sticky and we are dealing with bond yields that haven't fully reflected the fact that the Fed is just saying they're going to cut rates by only 3 times this year. Do you agree? Are stocks a better picture right now, albeit defensive, than bonds?
So we think that equities and fixed income markets are both overbought. We are actually a bit overweight fixed income at this point, but in the short-term fixed income part of the curve. And we think that is a good holding place here while we wait to see if this choppiness in the markets are going to continue. The S&P 500 has been up 14 of the last 15 weeks. And so a 10% correction at any point during a given year is a pretty normal occurrence. So we'd want to wait for maybe a bit of a reset in equity prices here before we'd want to move some of that short-term fixed income back into the equity markets.
Tracy, we know where the leadership has been on the way up. Where do you see it on the way down?
Yeah, on the way down, it's probably going to be similar to where it's been on the way up. The largest of the large caps have been outperforming since March. They've been dramatically outperforming small caps. We think there will be a time to invest in smaller cap companies and mid cap companies, but we think that that's not going to occur until we start to see evidence of a turn in the cycle. An early cycle is where we tend to see those perform better. So we are continuing to overweight large caps and especially quality large caps.
Tracy, Lisa's been talking about the buybacks that are taking place, specifically around some of these big tech names and the smaller ones as well. When you're waiting for that drawdown, that pullback in this equity market, aren't you fighting those forces? Just how powerful are those buyback programs?
Sure, they're very powerful and they can exert upward pressure on markets. We think that is going to counteract to some extent the weight that higher inflation and the Fed on hold for longer will exert on markets. And that's another reason why we're favoring companies that have good cash positions, companies that have low debt, because those are the ones that are more likely to initiate these buybacks and potentially continue to rise, even if the benchmark index as a whole is exhibiting some weakness.
I was struck by Instacart in particular because they're talking about laying off a significant part of their workforce while also increasing dividends and authorizing share buybacks. Is this what we're going to see, that potentially companies and stocks are going to keep doing well even if the economy starts to sour more materially?
That is a possibility. Certainly, fourth quarter earnings were positive for the largest of the large caps, but now companies are starting to say that they're more wary, less confident that they can pass along higher prices. So we do think that could weigh on margins, and that's probably why you're starting to see some of these cost-cutting efforts, which include reducing the size of their workforce. And eventually that's going to weigh on the labor markets and the consumer. And so, all of this is going to counterbalance some of the positives from the cost cuts.
Hey, Tracy, appreciate the update on some of your calls. Thank you. Tracy McMillan there of Wells Fargo. We talked about small caps briefly. As Lisa mentioned earlier in the programme, small caps yesterday, the Russell, down 4%. I was surprised to see that was the biggest one-day drop going back to 2022. That even going back to, say, spring of last year when we had the regional banks getting absolutely battered, that we were down some of those days by something like 3%. Yesterday was absolutely dreadful for small caps.
Which raises this question of whether we have the narrative a bit wrong. Who was it who came on the show and said, you guys are missing the plot? You saw a 30% rise in small caps heading into the end of last year in response to this idea of the Fed's pivot and just sort of this Goldilocks narrative. If you're seeing a little bit of frost taken off the top, okay, it's because of worries about some of the hangovers from debt and things, especially in a higher for longer kind of environment. This is going to be one of the big debates. When do they start turning around? When is the economy strong enough? And when is there rate security where you understand where things are going to get conviction?
Chris Ferrone, Strategas.
Thank you.
I don't think he had that hot CPI print in mind when he made some of those comments. Broader equities right now positive by 0.5% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Defense Secretary Lloyd Austin has been released from hospital after undergoing a procedure for a bladder problem. The Pentagon says he will work from home until later this week. He had canceled a planned trip to Brussels to meet with other defense chiefs and will now join virtually this morning. Austin was hospitalized in January following complications from prostate cancer, an episode which sparked furor because he waited days to inform the president and Congress. Donald Trump will likely drain his war chest for legal fees this summer. It leaves the GOP frontrunner crunched for cash ahead of November's polls. Trump spent more than $51 million in 2023 on legal expenses and can tap another $26 million from an allied super PAC to pay his lawyers. But as his 4 criminal cases ramp up, those funds are expected to dry up around July. Just as the RNC triggers the official start to the election campaign, it forces the frontrunner to tap the party or donors for more cash. UniCredit will increase its overall bonus pool for last year by about 16%. The Italian lender posted record profit and increased shareholder returns. The average gain per person will be higher than 2023, given the job reductions, with increases between 9 and 27%, according to sources. It also bucks the trend at other European investment banks who are planning to reduce pools after a challenging year for their securities units. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Democrat Tom Suozzi winning New York's special election.
Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
That conversation up next, live from New York City. This is Bloomberg. Stocks bouncing just a little bit on the S&P 500, positive here by 0.5%. Euro totally unchanged. Bond market rewinding some of yesterday's move. We're down about 2 basis points after climbing double digits through much of the curve yesterday. 429.27 on a 10-year this morning. Under surveillance this morning, Democrat Tom Suozzi winning New York's special election.
It's time to move beyond the petty partisan bickering and the finger pointing. It's time to focus on how to solve the problems. Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Here's the latest this morning. Suozzi replacing ousted Republican George Santos. The win cutting the GOP's already razor-thin House majority. Republicans currently holding 219 seats to Democrats 212. Bloomberg's Michael Shepard joins us now out of Washington, D.C. Mike, let's go to those numbers. How much of that was a referendum on Joe Biden?
You know, that's a great question. And we were kidding before the break about the snow, but really this was that fell in New York yesterday. But really, many have been looking to this election as something that would say more about what's going to happen in November between Joe Biden and Donald Trump. This is the rematch that nobody has wanted, yet we're all heading toward. But also what it means for the two parties as they try to gain control of these two closely contested chambers here in Washington on Capitol Hill.
It's an unnerving margin now that Speaker Johnson wakes up to. How does he deal with these kind of numbers when he wants to put very partisan bills on the floor, like the one last night to impeach Secretary Mayorkas?
Well, Annmarie, you hit the nail on the head right there with Mike Johnson's problem. This is the last thing he wanted out of this special election. He's already been dealing with this narrow margin. He can only afford to lose two Republicans on any party line vote. And as you mentioned, this Mayorkas impeachment, it lost a couple of Republicans who were questioning whether it was justified and whether they had enough under the Constitution to proceed. So if Mike Johnson runs into any tight spot where he needs Republican votes, he runs the risk of falling short potentially again and again if this issue comes up. Tom Suozzi hasn't been sworn in yet, but once he is, the margin will be 219 to 213.
Tom Suozzi used to be known as Mr. Salt. I feel like after the special election, he's known as Mr. Border. He was saying he would shut it down. He was saying he was bucking trends within his own party. What message does that send to the Biden campaign about how important the border issue, given the fact that this was a top election issue for voters in Long Island in the northeast of the United States?
Well, Annmarie, immigration and the border are really top issues across the board. And in our Bloomberg Morning Consult swing state poll, we found that 6 in 10 voters blame President Joe Biden for the troubles that we're seeing at the border with this surge of migrants crossing and just this sense nationally that the situation there is out of control. And certainly in New York, which has had to absorb 170,000 migrants in recent years, many of them shipped up there by Texas Governor Greg Abbott. All of that is coming home to roost in traditionally Democratic areas like New York. And voters there, even Democrats, are wondering, what is the president going to do? What was interesting in Suozzi's remarks last night was that he was addressing Republicans and flicking at the issue of immigration. He said, we need somebody to get things done. He was addressing people on the other side of the aisle. And you recall that Republicans walked away from the bipartisan deal on the border that included aid for Ukraine, Israel, and Taiwan. And it was one that Biden had agreed to and was ready to sign. Yet under pressure from Trump, they backed away.
Is there a lesson in this, Michael, that basically people who are known can get reelected, people who are not known are that much scarier after George Santos?
Well, I'm glad you asked that, Lisa, because in this case, Suozzi was really well known to the district. He had represented it for 6 years. He left Congress after 2022 to run for governor. Didn't work out. He sought the Democratic nomination that Kathy Hochul won, but his brand name still held some sway there. And what's interesting is that in Nassau County, Republicans really control the political apparatus there. The district spans both Queens and Nassau County, so he would be the lone county-wide, in a way, representative from the Democratic Party, and he will be representing them in Congress this time. His familiarity with voters certainly helped. And it also helped him raise money, and it also helped him with spending, too. He was able to outraise his opponent, Mazi Pilip, I think, by a 3-to-1 margin.
Let's talk about the weather. That didn't count as snow. I'm sorry. That was slush. They fell from the sky and then that melted by 2 p.m. Are we really blaming that, or is basically there just a complete lack of enthusiasm right now and low turnout all around?
Well, there is one question about this election, the 2024 election, too, about whether voters are exhausted, whether they have had enough of politics. The snow may have kept some people home in the morning, and certainly Nassau County the Nassau County executive flagged that as an issue in discussing it yesterday. He said, look, in the morning it was a little rough. He said that turnout picked up in the afternoon as things cleared up. But it was more than just the weather, clearly. People are a little fatigued with politics, and yet the stakes are very high entering this election as we head into a rematch of Joe Biden and Donald Trump.
It's the rematch not many people wanted. You see it in poll after poll. You look at the dysfunction down in Washington in Congress. It's increasingly frustrated. This is why there's so much fatigue, Michael. People are sick of it. We've been talking about deals that can get through the Senate but can't get through the House, things that can get through the House but can't get through the Senate. Can we talk about something that might pass both chambers, and that's a bipartisan tax effort? Michael, how close are we to that taking place?
Well, we seem to be inching closer and closer. One of the issues has been how this all gets paid for, and they are working this one through the process now. We're hoping for a little bit of action or movement later this week, but I will never bet on Congress doing anything on time or on schedule, especially with the tight partisan margins. There are some Republicans who are concerned, in particular, Annmarie brought up SALT, the state and local tax breaks that Democrats in particular are looking to restore. Those favor, the metropoli and the suburban areas of the nation. But for a lot of Republicans, they feel that benefits Democratic districts and states more than Republican ones. Hence, they're a little bit more hesitant to move through on something that has that provision.
Hey, Shep, good to catch up. Thanks for coming into the office for us early. Michael Shepard there of Bloomberg down in Washington, D.C. The constructive way of framing this is a feature of democracy, not a bug. You don't want it easy, Bramo. It's meant to be messy.
Okay, I actually adhere to that.
Don't want some dictator saying, this is the bill, this is the law.
You have to have people who are willing to consider the law before they vote on it. I mean, there is a difference between, the messiness that is built in and a feature of democracy and a messiness that is just a feature of politics and people trying to, create a certain image for TikTok or Instagram or Twitter.
You're suggesting it's the latter and not the former then currently?
It just feels a little bit different when people aren't even willing to consider the actual line items or discuss them. They're just talking about some kind of blanket ideology that is just going to mean no.
It's also much harder now for lawmakers to reach across the aisle and get a bipartisanship bill done. And the fact that we're getting ever closer to November election. Do you remember, though, we did have bipartisanship previously. We had a hard infrastructure package and we had the CHIPS and Science Act. When Congress has had to act in certain things they've really wanted to get done, they were able to. But the closer we get to November, every single decision you make is going to become political.
Good policy isn't good politics the closer you get to the election. Isn't this what's basically winding you up right now?
Honestly,
that and the snow.
Yes.
You seem to be furious about the snow yesterday, the fact that it was hardly any.
It was not good snow.
What would you describe as quality snow?
My family lives in this district, and they said it was cleared by 2 p.m. There's no issues voting. It was lame. It was lame
slush.
Snow.
It fell. It was wet.
It didn't
the
warrant
kids
a
went
snow
out
day.
there. They sled. They get mud all over because they're basically just sledding in a mud patch.
Of course.
You go into Central Park. It looks like Times Square. Everyone's trying to sled on tiny little patches and build small little snowmen. It was just not accurate.
Are you suggesting that Eric Adams wouldn't make a good meteorologist either? Is that what you're suggesting?
You're just trying to wind me up.
No, I'm just asking. They're just questions.
Look,
they're not loaded. They're not. Of course they're not.
All right.
They're just questions, Bramo. It's all they ever are.
Oh, yeah, always.
Coming up, Pierre Ferro of New Street Research on Nvidia's meteoric rise. That's coming up next from New York City. Stocks are positive. This is Bloomberg. The stock market's bouncing back here, as Lisa pointed out a little bit earlier this morning. The Russell of small caps yesterday down 4%. Biggest one-day loss going back to the summer of 2022. The Russell this morning up by a little more than 1%. Futures bouncing back on the Nasdaq as well by 0.65. On the S&P 500 higher by 0.5%. In the bond market, let's switch up the board and go to the 2-year. Take a look at the front end of the yield curve. We've had a move so far year to date of about 40 basis points. Down 3 basis points this morning to 462.65. What's interesting about the last 24 hours versus, say, things year to date, Lisa, over the last 6 weeks, is that yields have been repricing higher all year off the back of firmer than expected data, but equities had held up until yesterday after that CPI print.
It seemed to be maybe a gut check or a gut punch, as some people would say, when you take a look at inflation running hotter than expected and running hotter than expected across the board. So you asked a really good question yesterday. It's more of a market problem than it is a Fed problem, because this is exactly what they've been saying. It raises this question, though, especially if there's a broadening out in services inflation, about how long higher for longer really is. And frankly, it does raise the question of just how sticky inflation is, that a lot of people thought kind of was transitory.
For Fed officials right now, I think they can carry on saying the same thing. This is exactly why we wanted to wait for more good data. We didn't say anything about June. If anything, we said no to March, and we can push that back a little bit further as well. Those 3 cuts, they still look okay. I think they still look okay for 2024. Can that change in the next couple of months? Sure, it can. But the market was priced way more aggressively than that. And I'm not just talking about, what David Kelly at JP Morgan Asset Management said yesterday. I totally understand. The market pricing is a collective sort of average of a whole range of views, a hard landing, a soft landing. That 4 or 5 rate cuts doesn't speak to something super, super precise. But equities at all-time highs and spreads incredibly tight and yields coming back in, the so-called everything rally of the last 3 months, I think that speaks to the soft landing that the consensus view was kind of looking for.
And just to build that out, because I also like that, it's basically saying that there are people who are looking for a hard landing, and then there are people looking for a soft landing, and it's the average of the two. And the people who are looking for a hard landing are kind of getting blown out, sort of like that's not looking likely right now. So this raises the question, to Stuart Kaisers' point, how much does this really start to discuss or lean toward overinflating in some sort of significant way? That, I think, is what markets are grappling with a little bit more now.
So the UK was wondering whether they'd be spooked as well by hotter than expected inflation data. They weren't. If you just turn the board and go to sterling a little weaker against the US dollar, 125.55 on cable. We're negative by 0.3%. We were looking for something like 4.1 year over year. We got 4. Month over month, we were looking for negative 0.3. We got negative 0.6. So the right kind of downside surprise in the UK, with people on the MPC at the Bank of England still voting for rate hikes, a couple of them anyway, out of the 9. I think those hawkish wings got clipped by that data this morning.
And people are now calling for in next month or the month after, you're going to get some sort of rate cut from the Bank of England. It kind of highlights how different the inflation story is, though, in each region, right? It's not the same across the world, and the same kind of supply-driven inflation shock like what we saw, say, a couple of years ago.
We're still waiting for the Bank of Japan to start hiking interest rates.
Yeah, maybe that'll happen.
Everyone else started a a few Decembers ago. Under surveillance this morning, our top story, global bonds erasing all of the gains they made since Fed Chair Jay Powell's December pivot. Stickier than forecast CPI data in America, dashing investor hopes that the central bank would start cutting interest rates sooner rather than later. Later today, we'll hear from Chicago Fed President Austin Goolsbee and Michael Barr, Fed Vice Chair for Supervision. And Lisa, we've already touched on this, but ultimately, are you expecting any kind of change of communication from them whatsoever based on yesterday's print?
You know, I was wondering, does this matter, right? Is there going to be anything relevant from these comments? And there will be. And I think that it's compelling to me that a lot of analysts and economists are saying it's important to note whether or not they start to say this is just one data print. If they do, that can be viewed as somewhat dovish. And you can start to see that pushed into markets where, okay, expect them to cut rates in June and then progress with their cycle from there. If they don't, if they say this is concerning, or we need to look more carefully, or we want to see Supercore come down more aggressively, that's going to be treated as very hawkish. And I think that that's really what's going to tip the scales in markets today, potentially.
First reaction from the Federal Reserve, as Lisa points out a little bit later this morning. The latest on the politics, the House voting by the narrowest margin possible to impeach Homeland Security Secretary Alejandro Mayorkas after failing in their first attempt just last week. Mayorkas becoming the second cabinet member in history to be impeached. The last one was nearly 150 years ago. The effort is likely to die in the Senate, where a two-thirds majority is needed to convict and remove him from office. Annmarie, this is what we were talking about all morning. There are things that the House are able to do that the Senate just won't go with, and vice versa.
Well, this is politics, not policy. And the House really had to take up this bill again because it was an absolute embarrassment for Speaker Johnson to put something on the floor that he promised his base he would do and then not have the votes at the end of the day to shore it up. To get this across the finish line, we cannot just imagine how tight these numbers are. Steve Scalise is undergoing treatment for cancer, for blood cancer. He came back to Congress to take this vote. If Tom Suozzi was there in his new sworn seat he's going to have, that vote would have never went through. That's how tight the margins are right now. And that's why it's going to be really hard to get anything done in a bipartisan way, especially closer to November.
That margin gets slimmer and slimmer. Let's finish on this story, a lighter note. For Jeff Bezos anyway. The Amazon founder and chairman selling $4 billion worth of the company's stock in just 4 days. Prior to the sale, Bezos hadn't sold shares since 2021, the year he stepped down as CEO. Bezos still has a significant stake in the company, holding approximately 9.3% of outstanding shares. Amazon stock up about 11% so far this year. Annmarie, you went through the numbers. I want to hear those numbers again. The tax implications or lack thereof of doing this now versus before.
So he left Washington State and went to Florida. In Washington State, if you have gains above $250,000 from the sale of these capital gains tax, sales of shares, 7% is what you're taxed. 0 is what you're taxed in Florida. So if he was ever thinking of unloading, it would obviously be wise to move first and then unload. You could buy a lot more.
4 days, $4 billion. Can you imagine?
Yeah, and the savings, likely $288 million so far.
Oh.
So it raises this question, what's he going to do with it?
A lot of stand-up paddle boards.
Yeah, I don't think so. I think that there's some other things.
Lots of photos of him.
I'm sure that there's lots of other things, too.
What are you suggesting?
Well, I mean, he's got yachts, he's got islands, he's got, stylists.
Building rockets.
Yeah. I mean, what's
that
next?
Forever clock, which is pretty cool. Have you seen that?
No, I haven't seen that.
You should take a look at that.
Forever clock.
That's interesting.
I spent a lot of time yesterday looking at that cruise line because there was all this discussion.
Yeah, I'm not sure that Jeff Bezos is going on that cruise line anytime soon.
He has his own cruise line.
He could afford, though, if he wanted to, just to sort of charter it for a month and take the family on it.
Definitely.
It'd probably be a very lonely experience.
Take all of Amazon on it.
It's so big.
His family.
How many street blocks was that?
It's
3, 4, 5, 6.
You see it, it's parked in there. It's just basically a skyscraper.
I think my sort of idea of hell would be to go on that cruise ship. What was it? Icon of the Seas.
Icon of the Seas.
Icon of the Seas.
Yeah, it was actually an article. It was a Wall Street Journal article talking about doing it without the add-ons and what that would be like.
Okay.
I found it very compelling.
This is not what Pierre Ferragu wants to talk about, so let's talk about something he will want to discuss. A new year, the same story. Nvidia leading big tech higher yet again after jumping more than 200% last year, adding roughly $500 billion to its market cap, surpassing Amazon. It's become the world's 5th most valuable company and forcing analysts across Wall Street to chase this rally. Pierre Ferragu of New Street Research joins us now for more. Pierre, talk about chasing it. UBS have gone from 580 to 850 price target. Mizuho's gone from 625 to 825. I think the last time I looked, you were at 700. Can this name, Pierre, keep beating and raising through 2024?
Yeah, good question. I think when it comes to earnings momentum, things for 2024 look very, very, very solid, very good for Nvidia for a very simple reason, which is that there are way more people who need GPUs, who want to buy GPUs, and their supply chain can actually provide GPUs. So no risk on pricing, very healthy demand. And it's just a game for them every quarter to do as well as they can on their supply chain and on manufacturing. And so, when you're looking at manufacturing, you're guiding for the next quarter, you're being cautious, you're looking at the worst case scenario, and your execution is better, the execution of your suppliers is better, and you end up bidding. And so I think we're going to continue to do that, to see that. Now, if I'm telling you that, and if I've been telling you that for the last maybe 15 months, it's that it becomes very visible, and everybody knows it. And now the question is, how much of these bids are already in the stock after the rally you just mentioned? The stock is up about 50% year to date, and it tripled last year. So even if we see an addressable market that is growing very, very fast, we expect that the market is also doubling year on year and doubling again year on year and doubling again year on year. So it's difficult to know exactly where the rally stops, but very clearly the stock is already anticipating a lot of these revisions.
Pierre, it feels like an AI chip-related frenzy in the equity market. I was just going through your coverage list. You've got a buy on ARM, on Nvidia. You've got a buy on Intel. You've got a buy, I think, on Broadcom. You've also got a buy. There's a neutral on ASML. Can we talk about that just a moment, Pierre? Where does that neutral come from? Why are you so constructive on almost the complete universe, but not that name?
Yeah. So, let's take a step back. The AI market, this year it's going to be like 80 billion, and AMD said in 2027 it could be 400 billion. So a business that can quintuple in 4 years is good for everybody. So you should expect to have buy ratings on everybody. Now, when you look at players like ASML, AMAT, Lam Research, Tokyo Electron, so the guys who really sell the equipment, what we see there is that today they do almost half their business from China. And they do another very large chunk of their business, another 20-25% from the lagging edge, so lagging edge chips. And what we see today is that we think China is at risk. There is a lot of pressure for China to spend less. So we don't say it's going to happen, but we say it's a very high risk. And we think the lagging edge has been overspending for a year and is now very clearly cutting capex. Players like Infineon, Analog Devices, Texas Instruments, ST Micro, all these players are cutting capex. And so we are just like a tad cautious on an ASML, on an AMAT, and we just say they're going to benefit from AI. I mean, in order to build 400 billion chips in 2027, we need to spend ahead of that $50 billion in wafer equipment in order to have the production lines ready. So there is going to be a lot of business coming from AI, but it's going to come at a time where the majority of their business of today is actually going to pull back. And that's the reason why we are more cautious on the equipment players. The only one on which we have a buy rating is KLA-Tencor. And for the simple reason that KLA-Tencor is very, very little exposed to the lagging edge and to China compared to other players.
Just quickly, Pierre, I'm curious how much you're looking for dividends and share buybacks as announcements that could potentially support some of your buy recommendations and the others, not ASML, especially given what we saw from Meta, given what we just saw from Uber, and given what we've seen from a whole host of others.
I don't really have that on my radar screen, to be honest. You look at, if you're Nvidia today, you have this idea that maybe your addressable market could be $400 billion in 2027. But if you're honest about it, you have no idea, right? It's like we are discovering what AI could be, how fast adoption could grow, how fast models are growing, how fast usage is growing. So this $400 billion scenario is a possibility, but it's only a possibility. We could end up halfway there. And Nvidia has no control on that. Google has no control on that. Microsoft has no control on that. It's going to be a game of how fast the services are being adopted and how fast also the services are progressing. And so if things slow down, like for instance, you saw yesterday in the Wall Street Journal a report that people using the Copilot of Microsoft with the Office suite were a bit disappointed. if things slow down a bit, you could end up having a market of only 200 billions in 2027. Or like it will still be like amazing, a market going from 80 billion to 200 billions. And if that happens, you'll see a lot of turbulences in the stock. So is that a good point in time to look at buybacks and dividends? Maybe it's still a bit early. That's what I would say. But
yeah, just to jump in, I know you cover Uber. I just wanted to finish there. What did you make of that buyback from them this morning?
Well, when even before Uber IPO'd, we say in that ride-sharing business, it's very easy. If you manage to get the largest market share, only a single competitor will survive and will be on oxygen to survive. Will have a very hard time, and you are going to become a cash machine. And that's exactly what has unfolded over the last 4 years. And if you are a cash machine and, the street is still relatively cautious in the way it values your business, one of the best use of your cash you can do is to buy back your own stock, because with low multiples, buying back is actually very, very efficient. So, that's music to our ears. We're so happy to see that Uber is really playing out the way we were expecting, and we still have a very positive view on that name.
The stock is positive this morning, up by 6%. Pierre, wonderful to hear from you. As always, sir, Pierre Ferro there of New Street Research on Nvidia, some of the names elsewhere in that universe, and Uber this morning with its first share buyback. Bramo, that stock is up by about 6%.
I guess that if they have the cash, that's what people are doing with it. I think that share buybacks are running at something like the hottest pace ever in a February to start a year.
A $7 billion share buyback. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Shares in Airbnb are lower this morning after the company reported strong fourth quarter results, but did suggest early 2024 demand is waning. Earnings from the company initially came in strong on the back of continued post-pandemic travel demand, but Airbnb expects the number of nights and experiences booked that it will likely moderate this quarter as demand normalizes. Lyft stock has been on a wild ride since yesterday afternoon. The ride-sharing company posted earnings that beat estimates, but a clerical error in its press release caused the stock to surge a whopping 67%. Since then, it's come down to about 19% in the early trade. The mistake, an extra zero in Lyft's forecast for margins. The error listed margins expanding at 500 basis points instead of 50. I spoke to Dan Ives of Wedbush on the brief earlier this morning.
This was an episode of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through. And I think it's been a comedy show that we've seen at Lyft for years right now. And this is, even though it was a good quarter, it overshadowed by another black eye moment for Lyft.
A SpaceX rocket carrying a robotic moon lander has been postponed for 24 hours. The mission is now targeting a launch early Thursday morning Eastern time, with its intuitive machines-built Nova C aircraft payload aiming to touch down on the lunar surface about a week later. If successful, it will become the first privately built spacecraft to land on the moon. And that's your Bloomberg brief. John.
Danny, thank you. Appreciate the update. Up next on the program, and an even road to 2%.
There are certain aspects of this report which push the numbers higher. But overall, as this year goes on, we think the economy is going to grow more slowly. We think inflation is going to come down.
The latest reaction to that hot inflation print up next. One hour and about 41 minutes away from the opening bell. Equities bouncing back from the losses of yesterday. Equity futures on the S&P 500 positive by 0.5%. Yields lower by almost a basis point, 430.45 on a US 10-year. The surveillance this morning, and an even road to 2%.
From my perspective, all it says is, OK, the economy is cooling. It's just cooling more slowly. There are certain aspects of this report which push the numbers higher. But overall, as this year goes on, we think the economy is going to grow more slowly. We think inflation is going to come down on a year-over-year basis.
Here's the latest today. Hot inflation data erasing the last of the global bond market rally that began in December with Chair Powell's pivot. Colin Martin of Charles Schwab sticking with his initial forecast, writing this. This report throws some cold water on the Fed's rate cut plans. We've been expecting 3 to 4 rate cuts this year anyway, so now we're aligned with market expectations. We never bought into the aggressive pace of rate cuts that were being priced back in December and early January. Colin, I'm pleased to say, joins us now. So we've had this conversation, Colin, and good to see you, by the way, as always in person. We've been talking about this over the last 24 hours. Was this a bigger surprise, do you think, for the market than it was for, say, Fed officials?
I think so, just based on the market reaction. The market reaction, I'd say, was warranted. When you get a stronger than expected report like that, pretty much across the board, you're going to see markets react, especially given the expectations for those cuts. Now, they've been tempered a little bit. If you look at the Fed, if we go back to what most of the officials have been telling us, they've been talking about patience. I mean, that's what Powell told us, the need for more time, the need for more data. They want to be assured that inflation is moving down to 2%. And this kind of gives them a little bit more time to reevaluate the landscape and see what will happen going forward. We thought March was too soon. We're still kind of in that May camp right now. I think the odds are about 1% or 100% or so for May as opposed to June, based on Fed funds futures. We'll see how the next few months of data pan out, but we still expect 3 or 4 this year. We don't think this is a turning point. We don't necessarily expect a reacceleration in inflation.
Just to talk to the point that David Kelly was making, that it wasn't that the market was thinking we were going to get 6 rate cuts. It's that it was something between 12 rate cuts and 3 rate cuts, and sort of speaking to this idea of the potential for a hard landing. Has the market fully priced out a hard landing at a time where we're looking at data coming in hotter than expected, where we see the growth just coming in, again, stronger than expected?
I think you could argue that they've priced out a hard landing based on some of the market-based indicators like credit spreads, like the stock market. Sorry, my thing's falling out here, Lisa. Stock market at an all-time high over 5,000, obviously came back a little bit. What really surprised me yesterday was despite that stock market action, we saw credit spreads tighten. We saw high-yield bond spreads tighten. So if you look there, that to us is indicative of a healthy economy. I mean, otherwise, you'd see investors, you'd see lenders expecting and requesting higher spreads, and that wasn't the case. And that really shocked me yesterday, that despite all that volatility, despite the potential for higher for longer, that we saw spreads fall even more.
We were speaking earlier this morning with Rich Kosturek, and he was talking about how he's underweight bonds, partly because you are seeing the strength and you are expecting it to be a higher for longer environment. Do you agree that in the duration set, that in longer term treasuries, you see a bigger risk right now than you did, say, a couple weeks ago?
We don't see that. We're still in the camp that investors should gradually extend duration. We have a more long-term view, so if yields go up 20 basis points or so in the next week or so, that's not going to change our opinion. We'd have to see yields, sustainably move higher, and that's not really our base case right now. We still see a lot of our investors, a lot of our clients at Schwab in very short-term investments. And even if the timing of that rate cut gets pushed back a little bit, we think investors should still kind of move out a little bit and lock in those yields. Because, again, we don't expect a reacceleration in inflation. We don't expect the 10-year to get back to that 5% level we saw back then. So we're not underweight bonds. We still suggest investors move out a little bit on the yield curve. As it relates to credit, we're pretty much neutral across the board. The stronger than expected economy, the resilience we're seeing is obviously a good thing for corporations, but it's valuations that really get us a little hung up there, and why it holds us back a little bit from being more enthusiastic and from going overweight.
This conversation often gravitates to a discussion about the fundamentals. Can we talk about the psychology? So back in October, when yields were through 5%, no one wanted them. You drop towards 4, everyone's piling in. And then everyone's told Lisa and I over the last 2 months that if we get a backup in yields, we want to buy. OK, well, we've had a backup in yields of more than 40 basis points. What are your clients doing now? Are they still just sitting there in cash hoping we go up another 20? Another 50? What are they doing?
Well, I don't know what the number is, but yes, they are. And we hear that. And I think to psychology and behavioral ideas there, we kind of get anchored to that 5% we saw last year. And I know that's a level that a lot of investors were waiting for. And as you alluded to, no one really dove in then. I think there's 2 things. One, it's the hope that yields get back to that level. And I think a lot of investors, though, number 2, are probably a little bit scarred of what happened in 2021, but then more so in 2022. You go in now at, say, 4.25%, 4.3% on the 10-year, but then let's say yields do go up. That would be a big hit to the value of their bonds. So you have the hope for higher yields, and you have the skittishness, I think, of the potential price declines. So we are still seeing a lot of our clients focus more on the short end of the yield curve.
How low would yields have to go before you kind of shifted away from duration?
Maybe 3.5% or so before we get a little bit more cautious there. When we look at what the 10-year Treasury yield is right now and where it should be over time, based on our outlook for more of a soft landing, I know there's the soft and hard landing discussion. We're probably somewhere in the middle. We see rolling recessions. We also see rolling recoveries. But the yield curve inversion that we're seeing right now is not normal. I mean, from the Fed funds rate to the 10-year Treasury yield, it's near the lowest we've seen in decades. So assuming we get Fed rate cuts not because of a recession, just more for a normalization, we expect short-term yields to fall a lot more than long-term yields, and the 10-year might settle on that 3.5% to 4% area.
Interesting. Colin, appreciate the input, the insight, the reaction from the team at Charles Schwab. Colin Martin there, 2-year versus 10-year right now. Lisa, still negative, about 32 basis points.
It's de-inverted, though, quite considerably, considering that people have, you've seen both sides really come to the fore with short-term yields coming in for the most part over the past 6 months.
If you were looking for that aggressive bull steepener, though, that big rally at the front end off the back of terrible data or really tremendous inflation data to encourage the Fed to start cutting interest rates, not seeing it.
People don't understand this cycle, including myself, right? What the Fed's reaction function is going to be, how much they're going to cut, and then what longer-term inflation rates as well as the risk premia are going to look like. This is all unknown. We're territory unknown at this time.
You're not alone. Hardly anyone understands this cycle.
And it's really confusing.
2-year yields coming in about 3 or 4 basis points at the moment. That move's fading too. In the next hour, the third hour of Bloomberg Surveillance, Deepak Puri of Deutsche Bank, Ed Mills of Raymond James, and the brilliant David Rubenstein of the Carlyle Group just around the corner.
Fed is signaling to us that they're going to be very prudent about not lowering rates quickly.
I think the Fed's made the right choice. They can mute volatility with having a lot of bullets left in that gun.
The Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision.
I think it's going to be patient until they're very confident that things are heading in that right direction.
We're still thinking we'll avoid recession, so 3 rate cuts is what we get.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg. Alongside Lisa Abramowicz, together with Annmarie Hordern, I'm Jonathan Ferro. Bouncing back just a touch on the S&P 500, up by 0.5%. Big losses of small caps yesterday, down 4% at the close, up by something like 1% a little bit earlier this morning. The hits keep coming, Lisa. We need to talk about job cuts. This time, it's Continental.
Yeah, coming out. It is a German company cutting 7,150 positions. It makes auto parts, and it's talking about how it can cut costs. Pause. We've been hearing again and again job cuts at a time where employment rates are incredibly high, unemployment lower. JOLTS data came in, job openings came in hotter than expected. I understand this is in Germany, not in the United States. But what's correct? These headlines or the numbers? How do you square the two?
I'm thinking of many companies stateside as well doing the same thing.
Exactly.
And then you look at the data, jobless claims looking for 220 on claims when they come out. Later this week, up from 218. Unemployment's been south of 4% for 2 years. And we've seen example after example in sector after sector.
It's upside surprise after upside surprise. And you see job cut announcement after job cut announcement with hundreds of thousands of jobs cut, in particular from tech companies. Here's my question. How messy does it become to understand job cuts given the churn having to do with technology, given the churn due to different skill sets, due to the churn that a lot of companies have been holding off on executing until they had a better sense of the stability of the economy?
AMH, it makes the communication effort down in Washington even harder.
Yeah, it does, because you're trying to explain that, to your point, Jonathan, if unemployment has been under 4% for 2 years, then why are we seeing some of these job cuts? And then, of course, inflation. This has been the issue that has really rattled this presidency. And when you look at basic goods, especially food going up, dining out, electricity bills, obviously I've been talking about the only gem is that gas prices are going down. This starts to have an impact on consumers. Every single day they go to the grocery store. And that is what is so concerning. But, of course, you have to remember, is this just, I saw a lot of people on Twitter yesterday talking about seasonality because it's the start of a new year and there's going to be price adjustments. And Janet Yellen, the Secretary of Treasury, came out yesterday and said, look where we were and where we're going. And she's really loath to just comment on one report.
Not just shaking that equity market, that bond market too. And by the way, Treasury Secretary Janet Yellen, if that was a good print, they'd be talking all day about it. It's a bad print. It's only one data point.
Yeah.
If it doesn't fit the narrative, it's easy to discard, right?
Well, I mean, right now, probably more than ever. But that's one reason why a lot of people pushed back in their notes saying, you might not want to really just chalk this up to total seasonality.
Max Kettner, HSBC, he's been on top of this. Reverse Goldilocks. Any further signs of stickiness and inflation would bring another wave of reverse Goldilocks. We got a wave of that right the way through this market yesterday.
People trying to price in what a no landing scenario starts to look like. Don't you love this? This is such a fun game. No landing, soft landing, hard landing. But that's where we're at.
That's what we played how many times last year?
Lots of times.
I think this time last year we were in the no landing phase.
I think we're back there.
Right before the hard landing phase of March when banks started to fail.
Well,
it's almost like a repeater to, I'm not going to say any banks are going to fail, but it's like where we were 12 months ago.
I was thinking the exact same thing this morning. I was thinking, okay, so we went from soft landing to no landing. What's next? We should have a wheel.
We should
just spin it.
It feels like a ridiculous game with no prizes. Equities right now on the S&P 500. Session highs positive by 0.5%. The bond market looks like this. Yields lower by 2 basis points, 429.66. The next hour looks a little something like this. Coming up, Deepak Puri of Deutsche Bank on Wall Street's inflation wake-up call. Ed Mills of Raymond James on NATO becoming a political powder keg. And Bloomberg's Ira Jersey weighing in on fake rate cut expectations post-CPI. We begin with our top story. Inflation catching Wall Street off guard. Deepak Puri, America's CIO at Deutsche Bank International Private Bank, saying this: the strong CPI number alongside last week's jobs report will reinforce the Fed's view that a cautious approach will be needed. Our expectations remain that June will be the month where the first cuts will be seen. Deepak is with us around the table. Deepak, good to see you. What needs to happen between now and June to make that a reality?
Well, thank you, Jonathan. It's great to be here. I think the first thing that needs to happen is we need to avoid getting the prints like we got yesterday. But I think if you dig a bit deeper, it's really the labor market's dynamics, because it's not really the headline number or even the core number that hurt the investor sentiment. It's the super core. It's the services ex shelter that really drove this narrative that the disinflation traction is not really as embedded as what we were expecting. And why is that? That's really driven by your consumer discretionary spending. And given the labor markets are so tight, average hourly earnings took a uptick last time around. It's hard to see how the super core can come down to a level that'd be digestible for the Fed, especially Jay Powell, who has talked a lot more about super core, and that be the precondition for a rate cut. So I think you really need to see a couple of things. I'm pretty certain that the physical goods inflation is there, the energy being the wild card, I would say, but it's really hones down to the super core inflation that needs to materialize to a
So
global
ultimately,
level.
absent that, what is the real risk, the very real risk that inflation stabilizes above target? And why isn't that your base case?
Well, as I said, there are a lot of things that are happening. Just because it's one data point, the disinflation traction is there with us. I don't think that's going to go away anytime soon. What yesterday's number has told us that we shouldn't count on it. It's not going to be a linear single line decline on inflation front. And we need to be prepared for these kind of aberrations in the markets. And I think anyone who's thinking of this Goldilocks scenario, my concern now is that the Goldilocks can be can hurt on both sides. A, inflation can start to reaccelerate, which we saw yesterday. And B, the growth can start coming down. And I think markets probably not priced in for that.
Right now, it seems like the people who we speak to say really the only solution is to buy stocks, particularly in the U.S., because right now you're looking at inflation that does seem to be stickier on the heels of growth that does seem to be better. Do you agree with that, or do you think that that's a little bit too premature?
I think U.S. stocks, especially the big names, gives you a sense of comfort. There's a confidence size. I think it really started during the pandemic. I also take into account the money supply, the erratic money supply. And I was reading something from mid-1990s, the bygone era, Chairman Greenspan talking about the money supply and how that really propelled the stock market. And then a year later, he talked about rational exuberance, right? So my concern on the U.S. stocks, especially the big names, Lisa, is that we are really making a lot of money is flowing into these names, especially given the passive nature of the markets that we're living in. And it remains to be seen at 35 times the PE on the Mag 6, how much more comfort one can get. What we are telling our clients is that a better entry point might be coming your way this year. So rather than, for new money to stay put and not really start investing.
Just to be very clear, you kicked Tesla out. Is that why it's the Mag 6?
Mag 7, sorry.
Oh, sorry. I just wanted to make sure. This is something people are talking about.
One of the financial companies replaced Tesla, right? Berkshire is the seventh
it's
one.
It's gone from 7, 6,
exactly.
5, 4.
Well, I'm just wondering, exactly who it is. I know it's the Super 6 or whatever.
It raises a question, though. How much fragmentation are you seeing in the group of the big winners of last year?
Well, we started to see it already, right? The names that have done really well, who are doing a lot more buybacks, have done really well this year. And Meta being the cornerstone here. And then you see Tesla having some issues with regards to their ability to have the same light of profitability that they were using it. Now, I gave all this with the caveat that I'm not a fundamental analyst, so I want to reserve my views here. But I
should probably avoid this conversation entirely then.
Maybe that's a good idea.
Because it's not just Tesla, it's Apple as well. There are some names that are really, Lisa, starting to underperform versus, say, two names, which is Meta and Nvidia.
Which raises this question of, is this the beginning of some sort of new cycle where people are really looking for share buybacks, they're looking for dividends, they're looking for a certain level of performance? When you're talking about waiting for another entry point, what do you wait in?
Yeah, so I think there are a few things. A lot of the technicals are really quite positive for the bull market, right? So you look at the all-time high, you look at the a year out from the last rate hike, markets tend to be up mid-teens. Presidential election year without any challenger, that tends to be very positive. So there are some positives. However, in an election year, you also have a pretty copybook sort of performance of the markets. The first quarter tends to be positive. And then you have somewhat of a sideways to a mild correction going into the last 100 days prior to the election, where the markets have a high degree of volatility and tends to go down. A lot depends on what the market's sensing from the election. And then you have a relief rally post the election, no matter who goes into the White House. So I think you might get a much better entry point during the course of the year, maybe in the midsummer time frame than what you're seeing right now.
Is the election really something you can trade around, given the fact that we're looking at the longest general election in history?
Not necessarily, and we would advocate that your portfolio should be built to outlast one particular election cycle. Having said that, if you were to just ask me if this is the time today to start buying into the big tech, my suggestion would be no. Better entry points won't be coming.
Does it feel like the longest ever because it's just a repeat of the last one? So it's like it never ended.
It's just continued.
Just never ended.
Yeah, a long time.
Like 6-7 years of it.
Everyone's really happy.
Deepak, can we just finish on the cuts that we're seeing? Lisa went through Continental. I think we've seen it at UPS. Lisa, the other companies we've seen in the last week, can't list them off right now, but we've seen many.
Instagram, we've seen a whole host of places.
Snap as well over the last few years.
Not Instagram.
Operational efficiency is a phrase that we heard from Mike Wilson of Morgan Stanley. Is this the year of operational efficiency, and what does that mean for some of these companies?
Indeed, I think you're also hearing restructuring and layoffs as along with operational efficiencies. And I think in a sense, what the companies need to exhibit at this point, I think if last year was the AI, investments in there, which is still going to be a current theme this year, I think the market's looking for your profit margins. Are you able to protect your profit margins in an economy that's going to be slowing, in a consumer that's going to be slowing, and inflation, especially in the core side, might be stickier? So do you have the pricing power? Do you have the operational efficiencies to at least do well in this kind of a market environment, which is quite drastic or different than what we've seen in the last few years?
Deepak, it's good to see you. Thanks for dropping by. Thank you, sir. Deepak Puri there of Deutsche Bank International Private Bank. Just to recap that headline, Continental to cut 7,150 jobs, amounting to about 3.6% of its workforce. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Jeff Bezos has sold another $2 billion of Amazon shares after selling $2 billion last week. The sales accounted for 24 million shares and took place over just 4 trading days, according to the filings. The world's second richest man said he had plans to dispose as many as 50 million shares in the company he founded. Amazon is up 11% in this year. House Republicans voted by the narrowest possible margin to impeach Homeland Security Secretary, that's Alejandro Mayorkas. An attempt last week to impeach the secretary failed after a deadlock. A lawmaker returned from cancer treatment to reverse the embarrassing defeat. Mayorkas becomes the second cabinet member in U.S. history to be impeached, but the effort is likely to die in the Senate, where a two-thirds majority is needed to remove him from office. Trump will likely drain his war chest for legal fees this summer. It leaves the GOP frontrunner crunched for cash ahead of November's poll. Trump spent more than $51 million in 2023 on legal expenses and can tap another $26 million from an allied super PAC to pay his lawyers. But as his 4 criminal cases ramp up, those funds are expected to dry up around July, just as the RNC triggers the official start to the election campaign. It forces the frontrunner to tap the party or donors for more cash. That's your Bloomberg Brief. John.
Danny, thank you. Coming up on the program, up next, Biden blasting Trump's un-American NATO comments.
No other president in our history has ever bowed down to a Russian dictator. Let me say this as clearly as I can. I never will. For God's sake, it's dumb, it's shameful, it's dangerous, it's un-American.
That conversation up next. Live from New York City this morning. Good morning. Counting you down to the opening bout in the next hour. Equity futures bouncing here by 0.5%. We're doing okay. Yield to lower by a basis point or two. 429.86. Under surveillance this morning. Biden blasting Trump's un-American NATO comments.
Just a few days ago, Trump gave an invitation to Putin to invade some of our allies, NATO allies. Can you imagine? A former president of the United States saying that. The whole world heard it. The worst thing is he means it. No other president in our history has ever bowed down to a Russian dictator. Let me say this as clearly as I can. I never will. For God's sake, it's dumb, it's shameful, it's dangerous, it's un-American.
It's the latest today. NATO defense spending on the political chessboard for Biden and Trump. A record 18 out of 31 NATO countries expected to meet the alliance's defense spending goal this year. Secretary General Jens Stoltenberg telling reporters today European allies are spending more. However, some still have some way to go. Joining us now is Ed Mills, Washington policy analyst at Raymond James. Ed, let's talk about this topic and we can move on to the other issues taking place in Washington over the last 24 hours. Is NATO membership really on the ballot this year? It's not that straightforward, is it?
So, Jonathan, I think the thing that I would highlight, there's policy here, there's politics here. On the policy side, last December, the United States Congress added to the defense bill a provision that does not allow the president of the United States to unilaterally withdraw from NATO. He has to give a 180-day notice to Congress, and then Congress would have to vote for this. That's not going to happen. That is trying to future-proof kind of this NATO conversation from a potential re-election of Donald Trump here in November. Once Donald Trump made those comments, from a political perspective, the Biden administration has been on the ropes after Her's report last week and questions about his age. So it allows them to pivot and try to go on the offensive, trying to change the conversation. I think that's why we're talking about this morning.
But for the Trump campaign, and we heard from Robert O'Brien, who said that Trump was just giving some tough love. But for the Trump campaign, how much is this a cleanup act when they're getting in buildings and rooms with donors and supporters that actually want to see the United States stand by their alliance?
Yeah, so, I mean, what version are we on in terms of something that Trump has said, and then we're kind of having the quote-unquote cleanup act? There is kind of, that's the nature of who he is. That's the nature of the way in which he campaigns. Certainly for the Trump campaign, part of the way in which he's been getting this nomination so far is he hasn't done a lot of events. He hasn't said a lot of things. I think the way I look at this is I have felt that this election come November is most likely a rematch and most likely going to be very close because we're going to get a different set of headlines every day, every week, every month that we're debating. Does this move the needle one direction or in the other? The reality is that we're going to likely have two candidates with the majority of the country having a negative opinion, and the person who is able to win, those who don't like them, is probably going to be elected the president. And we're going to be debating that between now and November.
Can we talk about the foreign aid bill? You have individuals like Senator Lindsey Graham coming out and saying he's a no until it becomes a loan, something that Trump was putting out there. How hard is it to get this package done when the Senate and the House are so divided and the Republican Party itself is so divided?
So there are very few bills that get 70 votes in the Senate that don't ultimately become law. Now, is it this package as itself, or is it something different? That's going to be debated. But now the pressure is on the speaker. And there is either going to be a discharge petition, other parliamentarian kind of maneuvers, pressure for this to get a vote. And if this had a vote, this would have a majority. It probably has that 2/3 majority to get it done on the suspension calendar, which is how they've been doing things recently. So the fact that kind of Republicans are going to have to defend President Trump on his NATO comments, that puts a little bit more pressure. And also, obviously, last night, Democrats got another vote. That's more pressure, and you just need a simple majority to get a discharge petition, and then you need another simple majority to pass this. So from a defense supplemental, that $95 billion that passed the Senate, it has momentum because it had 70 votes and because how close the House is.
But barring a discharge petition, which right now people say is really fantasy land, if Speaker Johnson were to put this on the floor, would that mean him losing his job?
Yeah, we have said that if Johnson were to put it on as is, he'd be former Speaker Johnson. We have been talking to folks about other opportunities outside of this discharge petition and how you can get this done. We won't go into some of those arcane details. It's like defeating the previous question on a rule. However, this is something that a majority of the House members want to see. And you've even seen some House Freedom Caucus members admit if this were to get a vote, it would pass. So it's more about Johnson not having his fingerprints tied to something that ultimately gets signed into law.
So between now and potentially a government shutdown in March, what do you think actually gets done out of this Congress?
So the Senate's on recess this week and next week. The House is on recess next week. And so we have 3 days of session before March 1st. That's not a lot of time. So, do we get another push to have a short-term CR to get it from March 1st to March 8th? That's possible. Do we have a short-term shutdown? Does the State of the Union address on March 7th get delayed? That's possible. What we always tell folks here at Raymond James is that if there are kind of market volatility kind of tied to this, that disregard that, because the market's always up after that. And actually, during shutdowns since the 90s, since the Newt Gingrich, Bill Clinton era, markets on average are up during shutdowns. So the overall picture from DC is that there's a lot of fiscal support for this economy. And when you add in that $95 billion supplemental for defense, you add in the tax bill, which is still out there and still has a very good shot of getting passed as well. The spigot's on in DC. The support from a fiscal side is absolutely still there.
Do you see any of these fiscal potential bills like the foreign aid being attached to those appropriations, or do they have to go as standalones?
No, I think it gets a little bit more complicated when you attach it. What you've seen in the House is a pushback against the agreement that Speaker Johnson made on top line. Top line, we're going to do year over year flat on domestic, 3% or about $30 billion increase on defense spending. If you add to that number, you're going to have a package that year over year saw an increase when Republicans promised a decrease. That's politically very difficult. But we've also seen from Speaker Johnson a willingness to do things he said he was not going to do. And at the end of the day, you need to have a functioning government, even if it looks really dysfunctional through the process and that sausage making. So I'm not too hung up on if it's kind of one bill, three bills, but the most likely scenario, which is positive for the market, is that the majority of this, if not all of this, gets done. I've been on that grand bargain or bust train here for a while, and we're looking closer to that grand bargain at this point.
Interesting. Ed, it's so nice to try and talk about policy and less about politics. Ed Mills, thank you, sir, of Raymond James.
Thank you, John.
It's getting harder and harder to draw a distinction, though, between the two. You can see it in the polls that increasingly the Republican Party is becoming increasingly isolationist, which is what ultimately the former president is trying to speak to with offhand comments about NATO. At the same time, you want to take it seriously because the prospect that it may or may not happen in the future, I think it's really, really important. But then when you try and draw that divide between politics and policy, if you wanted to make that policy based on what's happened in this country over the last few months, it's going to be difficult to do that.
Well, right now, it sort of speaks to exactly that point, this idea of the deficit and how people are concerned about that at a time where everyone's talking about increasing spending. We just heard him say the spigots are on in Washington, D.C.
Yeah.
And this is part of the reason why people think that the U.S. economy can keep chugging along, maybe with a little bit more inflation to boot.
Soft landing, what's soft landing? City's Andrew Hollenhorst with a note out just a second ago. Not a soft landing. The US economy has entered a new regime where inflation is more elevated and more volatile. This has led to the FOMC keeping policy rates higher for longer, increasing the likelihood of a recession. Coming up next on this programme, investors pulling back rate cut bets following hotter than expected inflation data. That conversation up next. 60 minutes and a few seconds away from the up and about in New York City this morning. Good morning to you. Equities are bouncing back from yesterday's losses. We were down 4% at the close on a Russell. We're positive by more than 1% now on the S&P 500, negative close to 1.4%. Losses were worse than that. We chipped away at them going into the close yesterday. We're positive by 0.4% on the S&P at the moment. If you switch up the board and get to the bond market, 2-year, 10-year, 30-year, 2-year 460, 74. Yields are lower by, let's call it 5 basis points. On the 10-year, still in and around 430. Remember all the calls that when we go higher, we want to buy that. Lots of people want to buy that. And then yields keep going higher. We've moved 40 basis points, Lisa, year to date on the 10-year. Is that enough to say, yeah, didn't you say you were going to buy that? Aren't you buying that?
Well, it raises this question. Are we there yet in terms of fully pricing in how long the Fed's going to be higher for longer? You referenced this note from Citigroup's Andrew Hollenhorst.
Yeah.
I think it's fascinating, basically saying that this is not an aberration, what we got from that CPI report. This is the new reality of a more inflationary world. And I keep wondering whether we've actually priced that in or if people are kind of flirting with it. They're kind of wondering whether they can kind of commit to that or if it's just sort of, a trading.
It speaks to the difficulty of sort of calibrating policy to ensure that you get a soft landing is tremendously difficult given the volatility that Andrew's talking about and the continued strength in the US economy still today after been talking about this for 12 months, maybe longer?
I wonder if when we write the history books, I'm looking forward to that, reading someone actually explain what's going on because it feels kind of like we're in a mess.
When they join the dots for us.
Exactly.
Yeah.
I'm looking forward to reading someone painting by numbers because I would like the numbers. But how much the fiscal side of it really is playing into this. How much we're going to say, essentially, we're doing helicopter money. We've done that. And that's what we're seeing on the flip side of it. That, to me, is really going to be one of the key questions and where we end up in a prolonged period of time.
I remember years ago, Joe Weisenthal talking about hindsight capital. Hindsight capital is super, super easy, right? And when they write that book, we'll be able to say it was not easy when it was happening. Like, you make it sound really coherent now, but back then, there was nothing coherent about any of it.
You can tell the story that you want to with the data in terms of which you should pay attention to and which you should ignore, which is the reason why what we're talking about with markets right now is pricing out a range of potential outcomes that are completely opposite to one another. And this is what people are debating right now.
Retail sales tomorrow, that's another number to look for. We are looking for a negative print there. 0.2% is the estimate in our survey. Jobless claims as well, worth a look. 220, that's a number we'll be talking about tomorrow. 220 is the estimate against the previous read of 218. Final snapshot of foreign exchange for you with a little look at dollar yen. Worth a little look because yesterday we had more than a little move. A move of 1 percentage point on dollar yen against the Japanese yen in the dollar's favour, north of 150. Still north of 150 now, 150.54. We're negative on that currency pair by 0.2%. That is just a minuscule Tiny piece of yen strength off the back of some jawboning from Japanese officials yesterday, threatening to do something about it.
Threatening, saying it's because of speculation, which is not helpful. And people said, OK, so when do you start to take action? Because right now they've been doing a lot of jawboning. They haven't taken action. And I think maybe markets are they're kind of sick of being whipsawed by just simply rhetoric.
Without a doubt. Dollar yen right now, 150.55. As Lisa points out, we're waiting for the action, not the words. Under surveillance this morning, your top stories: Lyft's blockbuster earnings report showing a year-over-year revenue increase, a jump in bookings, and an upbeat outlook. There was just one problem: a clerical error stating margins were set to grow by 500 basis points. 500. And not 50. The company's CFO issuing a correction on the earnings call, saying the press release was incorrect. Shares pairing gains after an initial 67% surge. The mistake overshadowing an otherwise solid quarter for Lyft as it tries to keep up with its main competitor, Uber. Coming up at 11 a.m, Bloomberg Technology will catch up with the Lyft CEO. And I imagine they've got some questions for dear David about what on earth was in that release yesterday.
Do they have a copy editor? I mean, seriously, who reads it over?
You'd have to imagine they did.
The CFO, at the end of the day, before it goes out, has to read this over.
That's what
right?
I want to know. It's just process.
Room of lawyers.
Let's just talk about what happened that day. Sit down.
What did Dan Ives of Wedbush say to the team this morning? It was like an episode from SNL, except it was real.
He was saying it was like Airplane. I mean, this is sort of the level of incompetency that it suggests. How do you then build confidence that there's not incompetency of that nature elsewhere in operations?
If you were sure, I mean, I'd love to talk to someone who was sure and how they really feel about this. This is beyond a clerical error. This is not sort of a simple, 50 to 500. That's a huge, huge difference. And the amount of people that would have read through that to miss it. A friend of mine said it's one of those situations where you sort of see what you want to see and not what's actually there. That we all want to say, if you're working at the company, we want to be able to say margins are going up 500, but they're not. They're going up 50. That's just a completely different figure.
Well, do you think that there was some intention behind it?
I can't imply that.
But it was convenient.
It was certainly convenient to squeeze out shores. It's worked that way. We can talk about the consequences of it. Got no idea what the motives were at all. A mistake or otherwise.
Yeah, I assume that they're going to have to demonstrate how it was not intentional, but at the same time, it doesn't just represent complete humorous incompetency.
Yeah, it doesn't speak well of the broader management there. If you can make those kind of mistakes, we'll be talking about it a little bit later with the CEO. Let's turn to the politics. Democrats picking up a seat in the House as Tom Suozzi wins the vacant seat left by ousted Republican George Santos. Queens and Long Island voters propelling Suozzi, who previously held the seat, to victory over opponent Marzi Pillar. Suozzi winning 53.9% to 46.1% with 93% of the votes counted. The race seen nationally as a referendum on President Biden and immigration policy. The GOP currently holds 219 to 212 majority in the House. It gets slimmer and slimmer.
Well, this is what is so concerning if you're waking up and your speaker, Mike Johnson. Your majority is getting whittled down day by day. And when you want to put partisan bills through Congress, it's going to be very challenging, and every member has to show up for those votes. To say that it's a referendum on Biden, I find interesting because Tom Suozzi is also a different candidate. He held this district. He knows these constituents. I think there's a little bit more to say about not so much that she wasn't a quality candidate, but name recognition ID.
I think the nature of the race is going to be interesting as well. If you think about the races getting closer and closer to the election, around the election for the national campaign, will it actually be a referendum on Biden, or will the Democrats, these candidates, actually put distance, some daylight between themselves and the president?
Well, that's what Tom Suozzi did. That's what the Connecticut governor did when he was sitting around this table saying Biden should be closing down the border. You're seeing Democrats from blue cities point the finger at the President Biden to do more when it comes to the border because it's now impacting them and their constituents.
Less politics, more price action. You're tuning in for that, I'm sure. Yields are lower at the front end of the curve, down 5 basis points on a 2-year, 460. Traders over the last day or so adjusting their rate cut forecast after CPI came in hotter than expected. Global bonds have now erased all the gains they made since Fed Chair Jay Powell's December pivot. Fed reaction coming a little bit later. Goolsby, Barr, Waller, Bostic, Daly, all coming out to round out the week, reacting to that data. Let's catch up with Bloomberg's Ira Jersey to talk a little bit more about this. Ira joins us right now. Ira, did anything change for you with that print yesterday morning?
Well, it didn't change anything for us because we had thought that inflation was going to come down much slower than what consensus was pricing. We've been talking about the idea that that Treasury tips break even, so the break even inflation rate that the market was pricing, as well as the number of cuts that were being priced for this year was unrealistically low. So we were talking about having five or six interest rate cuts this year by the Fed. Our call has been 3 for the whole year. And I think this just solidifies that idea that maybe they hike once before mid-year, and then we really wait to see what the data is in the second half of the year before the Fed can actually cut much more.
All right, can we talk about the data a little bit more? We had a conversation with Sarah Wolf of Morgan Stanley early this morning, and she was talking about the gap between CPI and PCE. How big is that gap at the moment, and what explains it?
Yeah, well, it's growing. It has grown, and we'll see, obviously, on Friday what the PPI data comes in. Yeah, the interesting thing about CPI, PPI, particularly in the core measure, that tends to have a pretty good relationship with things like corporate earnings, right? So that's one of the reasons, perhaps, why it shows that businesses still have some pricing power, even though a lot of the inflation that we're seeing is in the service sector. So if you look at services wages and where the inflation was yesterday, it was almost all in services, and that means that if you can grow your, as long as you can keep your price increases more than what you're paying employees and wages, you're likely to see, decent uptick in earnings from an economic perspective. I think importantly, you mentioned, John, at the top of the half hour about tomorrow's retail sales report. I think that's going to be key, because if we get the retail sales control group coming in above the 0.2% that's expected, I think that'll be a big sign that the recovery or the continued expansion that we're having is still on track.
And what sells off more, the front end or the long end?
Probably the front end. I think if you get something like a 0.4, 0.5 on the control group tomorrow, you can wind up, pricing out yet another interest rate cut that we have for this year. So if we get the 3 cuts that the Fed Stotts, ourselves, and even Governor Waller mentioned a couple of weeks ago, you can wind up with 2-year yields at around 4.75%. So another 15 basis points or so higher from where they are right now. Now the whole curve will probably go up, but I think the front end still takes a brunt of it, just because the Fed's going to be on hold for a little bit longer than the market was anticipating.
The reason why I ask, and John was talking about this note from Angie Hollenhorst and Veronica Clark over at Citigroup just moments ago, where he said, stronger 0.4% month-over-month core CPI is not an aberration. The U.S. economy has entered a new regime where inflation is more elevated and more volatile. Higher for longer is definitely going to be the case. Do you agree with that assessment, Ira? Is this sort of a stickier inflation where this rate isn't as restrictive by the Fed as many people think?
Well, I think that's very possible, and that was certainly the discussion point that I was having with a lot of investors yesterday. In fact, there is a camp out there that believes that the Federal Reserve should probably be increasing interest rates even more. I think that that's pretty unlikely that the Federal Reserve is going to start hiking, because the first thing that we need to do, and I think that the Federal Reserve has to acknowledge, is that they have to jawbone out a lot of the cuts that are being priced not only for this year but also for 2025. And quite frankly, pricing out those cuts is as good as them hiking, because the fact that you have this inverted yield curve and the expectation that they're going to cut interest rates quite substantially over the next 18 months is easing financial conditions quite a lot. And I think that's something that the Fed has to acknowledge a little more forcefully. And I suspect in some of the discussions and some of the speeches that we'll have over the next couple of weeks that they will actually be saying, like, look, we might not cut at all if inflation continues to run at over 3%, which I think will have pretty significant implications for, particularly that front end of the curve that we just talked about, where you can see yields continue to move somewhat higher.
Russ Kosterich earlier this morning from BlackRock was talking about how he doesn't really like bonds all that much based on the fact that there's supply and there are concerns about inflation and all of this. And I'm wondering whether we're going to start worrying about auctions again now that yields are a little bit higher. Is this going to be sort of a new focus where people now, once again, worry about the deficit?
I think so. It's the auctions have been odd, right? Because the January auctions didn't go very well, but the refunding auctions that we had just last week, they all went very well. The 10-year and the 30-year in particular did much better than we had anticipated. We had thought that they would be a little bit choppier, but demand by end users was good. I suspect that there will be some bottom picking and some folks who are say short the market, where if you look at some of the survey data and some of the positioning data that we look at, it does suggest that the market is leaning modestly short right now. So you might have some short covering at some of those auctions, and also maybe some people just adding a little bit of duration as yields get higher, particularly if we get up to around 4.4%. So that's the next really important technical level on the 10-year. That's a 50% Fibonacci retracement, and that's going to be my focus. Above 440, and I think you can actually extend the sell-off much more, but that 440 level, I think we'll start to see some buying.
The market moving closer to you and this Federal Reserve. Ira, thank you, sir. Ira Jersey of Bloomberg Intelligence. These traders on Wall Street are such a romantic bunch. New rhyme for you, little poem. Roses are red, violets are blue, inflation is sticky, we're nowhere near two. That comes from Kevin Higgs out on Twitter. That's better than the ECB's.
It's direct response to the ECB.
Isn't it nice? I think that's great.
Oh, is that your Valentine's
Happy
wish
Valentine's
to everybody?
Day, Wall Street, without a doubt. That's our wish, isn't it? Get back to 2%. Just a beautiful thing. On a bed of roses.
Do you celebrate?
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. And Danny Berger. Hey, Danny.
Hey, John. Donald Trump will likely drain his war chest for legal fees this summer, leaving the GOP frontrunner crunch for cash ahead of November's poll. Trump spent more than $51 million in 2023 on legal expenses and can tap another $26 million from an allied super PAC to pay his lawyers. But as his 4 criminal cases ramp up, those funds are expected to dry up around July. That's just as the RNC triggers the official start to the election campaign. It also forces the frontrunner to tap the party or donors for more cash. Jeff Bezos has sold another $2 billion of Amazon shares. That's after he already spent $2 billion last week selling the stock. Regulatory filings show the sales account for 24 million shares, and they took place just over 4 trading days. The world's second richest man has said he plans to sell as many as 50 million shares in the company he founded. Shares of Amazon are up 11% so far this year. Shares in Airbnb are lower in the early trade. The company reported strong fourth quarter results, but suggested early 24 demand is waiting. Earnings from the company initially came in strong on the back of continued post-pandemic travel demand, but Airbnb expects the number of nights and experiences booked will likely moderate this quarter as demand normalizes. That's your Bloomberg brief. John.
Danny, thank you. Appreciate the update. Up next on the program, Alphabet's $100 billion cash pile.
We're continuing to invest in the business. There's a lot of extraordinary upside in the business. And then we do make investments and acquisitions, so do all of our peers.
More on that conversation coming up next. Counting you down to the opening bell, 45 minutes away. Equity futures near session highs, positive here by 0.6%. Live from New York, this is Bloomberg. Live from New York City this morning. Good morning. 9:30 Eastern Time. Your opening bell about 42 minutes away or so. 8:47 Eastern Time right now. Equity futures at the moment positive 0.5%, bouncing back from yesterday's losses. Yields were up big time yesterday off the back of that hotter than expected CPI report. They're down a touch this morning by not even a basis point on a 10-year. 430.84. Under surveillance this morning, Alphabet's $100 billion cash pile.
We're continuing to invest in the business. There's a lot of extraordinary upside in the business. And then we do make investments and acquisitions, so do all of our peers. There's a lot that's exciting going on in the world. And so we're looking across the board. Starts within the business, then it goes to investments and acquisitions, then obviously return of capital through a not inconsequential share repurchase program.
You can watch the full conversation with Alphabet President Ruth Porat tonight on the David Rubenstein Show. Peer-to-peer conversations. I'm pleased to say that David's catching up with us to talk about that chat right now. David, good morning to you.
Good morning. Thank you for having me.
Great to catch up with you. Ruth Porat's storied career, not just on the West Coast and Silicon Valley, but also on Wall Street, and has faced existential crises in the past with Morgan Stanley right at the epicenter of the financial crisis. I'm wondering from your conversation, did you get the sense that Alphabet feels like they're facing one of those right now?
No, I mean, she's lived through the crisis of 07, 08 with Morgan Stanley, where Morgan Stanley came very close to having to file for bankruptcy, and they obviously survived. As the CFO, she did a great job there and was recruited away to be the CFO of now Alphabet, then Google. And now she's been promoted to be the president and chief investment officer. So she's got the highest job you could probably get as a non-engineer at that company. And she's got more than $100 billion cash pile to invest. So she's very popular with Wall Street people, for sure.
It feels like that AI is the threat, potentially the existential threat to the core business of Alphabet. Did she say much about that, David?
We did talk about it. I wouldn't say she thinks it's a threat. She would say it's an opportunity, because while Microsoft has gotten a lot of attention and obviously very strong in AI, Google has a lot of AI capabilities as well. And when they start putting that on their platform, I suspect it will really enhance the use of Google.
I want to talk about share repurchases. This morning, Uber announced a $7 billion inaugural share repurchase. We've seen incredible amounts of share repurchases and dividends, Meta with their new dividend. Is this the new playbook, that essentially it's not about pie in the sky and it's not about the metaverse and it's not about that? It's just cold, hard cash?
Well, it's hard to make a lot of acquisitions these days with cash because the Justice Department, the FTC, don't seem to be approving very many things of any consequence, so that's a factor. Secondly, these companies are making a lot of cash, and there's no doubt that while there's a tax on share repurchases, it's a modest tax, relatively speaking. So people that want to do share repurchases are going to do them despite the 1% tax that occurs now. So I think if you've got a lot of cash, giving it back to your shareholders is good. It's hard to make acquisitions of size these days without having regulatory problems.
So is that the reason why you think you're going to see this a whole lot more?
I suspect you'll see more of it for the time being. Now, if you have a lot of cash, regulators sometimes don't like you to do share buybacks. That's why the Congress imposed a tax, but they don't like you to make acquisitions either. So it's, it's a difficult situation.
Do you expect the cash to be deployed into sports teams more frequently?
I suspect probably not.
That's exactly the question I was going to ask.
I think individuals, to be honest, publicly traded companies don't yet typically buy sports teams, at least in the United States. They do overseas. So it's mostly wealthy entrepreneurs or other people who have the cash to do that. And I suspect you'll see more of it because the values of sports teams has risen dramatically in the last couple of years. When the New York Yankees were bought by George Steinbrenner, I think it was in the 1970s, he paid roughly, I think, $8 million for the team.
That's amazing.
$8 million. When the Baltimore Orioles were brought to Baltimore in 1954, they were paid, the purchase price was $2.2 million. So these teams tend to go up in value. They don't tend to go down.
There is a feeling here that maybe we've reached a saturation point with the competition for sports TV rights, and that potentially we might have reached the limit for how much a franchise is worth. Would you push back against that in some way?
Well, people always say this is the highest price anybody will ever pay for anything, and the world keeps going on because we have inflation and so forth. Clearly, there's only a limited number of people that can watch a game, or how many people you have on the face of the earth. Everybody can't watch every game, and even so, these prices have gone up. So, for example, take the most recent Super Bowl game. More people apparently watched that than watched any television event since the moon landing in 1969. So there are a lot of people out there who like to watch sports. There's nothing wrong with it. And,
do they like American football or do they like sports? Because American football has absolutely dominated TV ratings. What can baseball do to get there?
Well, there are two different types of things. More people go to Major League Baseball games every year to go to NFL football games. Obviously, the more games. But you have a lot of people showing up at the games. And the TV rights, though, there's no doubt that NFL dominates television. If the top 50 shows on television history in the United States, probably 40 of them, or 45 or so, are NFL games of one type or another. It's just unbelievable.
If someone's tuning in and they don't know why we're talking about this, it's because you have invested in the Baltimore Orioles, almost $2 billion.
I thought we were dancing around that.
Yeah,
Lisa.
well, I'm just going to go directly at it. I mean, what is this? This is ridiculous. But I want to ask you, why? Is it a sort of nostalgia play? Is it because of the investment for the valuation?
A couple of things. First, I am from Baltimore, and I grew up rooting for the Baltimore Orioles. And I should point out that the league has not approved me yet. I have to be approved by the ownership committee. So a deal has been announced between the current owner and a group that I put together, but it's not technically approved. Hopefully it'll be approved at some point in the not too distant future. But for the time being, I would say I'm interested in it because I want to give back to my hometown. I enjoy sports. I think it's a very good investment opportunity. So for all those reasons.
What's the courtship like? Do you have to go to them and explain kind of what you would do, or do you have to kind of give them a sense of your commitment to Baltimore? I'm just curious about the process of this type of thing.
Well, they asked if I would go on surveillance and talk about it, and I said I would. So that was the main reason that they agreed to let me do it. I actually think that anybody that sells a sports franchise doesn't want to sell it to somebody who's going to ruin the franchise. So you have to say why you think you can make it even better than somebody's already had it, did with it. So I think we can do a good job with it, but we're going to bring back a lot of people that are well known in Baltimore. Cal Ripken is a good example. Will be investing with us and other things. So I think we can assemble a good group of people who care about Baltimore. And one of those people who care about Baltimore is a guy named Mike Bloomberg.
Okay, I've heard of him.
I've heard of him too. I didn't know he was an Orioles supporter.
Mike is a graduate of Johns Hopkins, and I think has given more money to Johns Hopkins than any single individual in the history of our country has given to any other one university.
That is true.
So I think roughly $5 billion, I don't know exactly, but something like that. So he cares about Baltimore and is happy to participate in this as well.
Possibly the Red Sox a little bit more than maybe the Orioles. Maybe. I thought Boston sports was the thing for Mike.
Well,
I'm going to drop by the desk after this and make sure I'm not getting in trouble.
Well, Mike is probably watching, but I think his main sport might be golf, but he does like baseball.
That is true as well. Can we just finish? Just a final word.
Okay.
International investment in American sports. We've seen a lot of it go the other way. Are you expecting more international investment in American sports? Are we going to open the doors to the Saudis, for instance?
There's a certain xenophobia in the United States with certain parts of the world investing here. So I think if I think Saudi investors, Chinese investors, Russian investors would raise eyebrows, to be honest. So I think also the American sports tend not to be as global in that sense. So English Premier League is a global sport. American baseball, American football tends to be more of a American sport. Now, NBA basketball is becoming more global, but I think you're more likely to find American entrepreneurs buying these teams than global companies or firms.
Interesting.
Right now, only one NBA team has a sovereign wealth team, a sovereign wealth fund investing with it. Sovereign wealth funds have not been approved by the NFL or the Major League Baseball. So at some point, sovereign wealth funds will probably be investing, but right now they're generally not.
We got to go. David, thank you.
My pleasure. Thank you for having me.